The crypto infinite money glitch appears to be broken, and we may never truly know what went wrong. The way it was supposed to work is that you could take an irrelevant company, raise capital to buy Bitcoin or some other token, they're all basically the same, then tweet something quasi-religious about the future of money and put a lot of effort into creating AI memes, as good AI memes will definitely drive the token price up. I mean, that's in corporate finance textbooks at this point. This starts the flywheel spinning. The crypto goes up, pushing your stock price up. Then you sell more stock to raise money, buy more crypto, rinse and repeat. If there are any annoying questions about cash flow, PE ratios, or the fundamental laws of thermodynamics, that's possibly just a sign that you need to crank out more AI memes. Why run a business which is dull and boring and can go wrong in many, many ways when you can just buy something, tweet about it, and pump its price? I'm possibly making it sound too simple. One of the real innovations of crypto treasury companies, as they became known, was to monetize the volatility of your stock. If your stock price jumps around like a caffeinated squirrel, or has a high standard deviation, as nerds would say, you could monetize that volatility by issuing low or zero coupon convertible bonds. The more volatile your stock price is, the more the embedded conversion option is worth. And the convertible bonds will be bought by hedge funds who don't necessarily believe in your company or the underlying crypto token, but they are able to make money through gamma trading, which I'll explain in more detail later in the video. But it involves buying a convertible bond, short selling the stock against it on a ratio so that you're market neutral, and then constantly adjusting your position size as the stock price moves around. The hedge fund can make money from this while keeping its combined position stock price neutral. These guys don't care about the company or the Shiba Inu-based token that you're claiming drives its value. They just care about the stock price moving around a lot, which your AI memes and unhinged tweets are supposed to cause. This is a virtuous circle, or some sort of a circle anyhow, as it allows the CEO of a once failing company to raise cheap capital to buy stupid tokens, while providing hedge funds with profitable market neutral trading opportunities. Look, you can be as negative about this as you want to be, and I know you guys can be judgmental, but it worked like a cheat code in a video game, where companies could raise funds to buy crypto. That buying drove up the token prices. The firm's stock price often went up even more than the crypto did, as idiots would buy the stock. Your quasi-religious tweets and memes stir up your followers on the Everything app, were good for social media platforms, and provided a real use case for Sora too. This was hype capitalism at its best. Whether you like it or not, it's just how things work. It's maybe even how things should work, as why have a company that does something when you could just have a company that buys something and pumps its price up? It's better, it's more efficient. Over the last year, crypto treasury companies revolutionized the way that businesses worked. And while it started with MicroStrategy and Bitcoin, managers of other irrelevant companies worked out that you could stuff pretty much anything into this structure, as if you think about it, everything can be scarce if you raise enough money to buy all of it. The way I see it is that business has just been too complicated for too long. The guy with the high-pitched voice and the Bitcoins worked out that businesses, if you separate them from business activity, can be much more efficient. Elon Musk, who spent billions of dollars on AI so that he could have a cartoon girlfriend, says that most jobs will eventually become optional, comparable to hobbies like playing sports or gardening. He explained at a US Saudi investment forum that this can all happen as long as we create an AI that cares deeply about truth and beauty. And you're not going to find a group that cares more about truth and beauty than the people attending an Elon Musk speech at a US Saudi investment forum. In this brave new world, where everyone is living large and no one is working, we're going to need our infinite money glitches to keep it all afloat. But the problem now is that the cheat code seems to have stopped working. Strategy is no longer trading on animal spirits. It's been dragged down by financial gravity. Since the company went all in on Bitcoin, it has hardly any other sources of revenue and now owes $800 million a year in dividends and debt interest payments. The massive premium to net asset value, which was the magic dust that made the share issuance accretive, has evaporated to a pedestrian 1.15 times. Worse than that, some of the copycat firms are now even trading at a discount to their crypto NAVs. Before we dig into what's gone wrong, let me tell you about this week's video sponsor, Saley, an eSIM provider who makes it incredibly easy to travel and stay connected without having to pay ridiculous foreign roaming charges, find a local SIM card, or search around constantly for public Wi-Fi. I hadn't heard of this technology before trying out Saley this summer, but it's an app that you install on your phone which allows you to stay connected in over 200 places around the world. There's no need to buy and swap physical SIM cards when you travel. You just download the app once and use it whenever you're abroad. You choose how much data you want and for how long. It's way cheaper than roaming and takes seconds to set up. You just select the country and plan and activate an eSIM before you leave home. And when you land, your phone automatically connects to a local network with no hidden charges. There's no fussing around at the airport. You can book an Uber, access GPS, or make a call. So if you've got travel plans, click the link or scan this QR code to download the app. Choose a plan in the country you're going to and use my code BOILE at checkout to get an exclusive 15% discount. Look, no one loved the crypto boom more than me. I loved the people. SBF and Caroline the Wood Nymph provided endless entertainment. There was the art, the games, and of course the music. Who can forget the music? A lot has changed over the last few years, however. The people are now politicians. One is even a FIFA laureate. And SBF went from being the most generous billionaire to a guy who can't even afford to buy himself a pardon. Presidential pardons in 2025 became the new NFTs. If you're big in crypto, then you'll have a collection of them framed on your wall. To understand the strategy collapse, you have to understand the bizarre arithmetic that drove the boom. The entire strategy trade relied on a single fragile variable, the premium. For most of 2024 and 2025, investors were willing to pay around $2 for every $1 of Bitcoin on Strategy's balance sheet. Why? Because Strategy offered something you couldn't get elsewhere, leverage without the margin call. If you took a leveraged position in Bitcoin on an exchange and the price crashed, you got liquidated. If you bought Strategy stock, you got loads of Bitcoin exposure, but if it tanked, you still had a huge loss, but you could hold on to your position and hope for a bounce. I made a video about crypto treasury companies last summer, and in the comments section, Strategy cheerleaders were arguing that the business was valuable and should trade at a premium because without it, investors couldn't easily get leveraged exposure to Bitcoin. But even then, there were more than 100 other companies already doing the exact same thing, many at lower premiums. It just didn't make sense to pay $2 for a dollar's worth of Bitcoin. This premium above NAV was a good thing, according to Strategy investors, however, as it created a recursive loop. If the stock trades at $200 but represents only $100 of Bitcoin, the company, they said, could issue a new share at $200, buy $200 worth of Bitcoin, and suddenly the Bitcoin per share of the existing holders, or hodlers, went up. The way investors saw it, dilution was actually accretive. It was a magic trick where the more stock Strategy sold to buy Bitcoin, the richer the existing shareholders became. As of the time of this recording, Bitcoin is trading at around $90,000, which is down about 5% year to date. That includes dividends and other cash flows. Strategy, on the other hand, is down around 40% year to date, which is worse. Strategy is and was a very volatile stock. While it wasn't an S&P 500 member, it was more volatile than any other stock in that index, even meme stocks like Tesla and Palantir. Its high volatility enabled the convertible bond issuance that I described earlier. But for a certain type of investor, the most volatile stock wasn't volatile enough. Retail traders piled into leveraged single stock ETFs tied to strategy like MSTX and MSTU, which are down around 85% year to date. According to Bloomberg, that puts them among the 10 worst performing funds in the entire US ETF market, out of more than 4,700 products currently trading. One of these leverage strategy ETFs, MSTP, was only launched in June and is down almost 85%. If you invested in these, you should probably keep quiet about it so a court doesn't order Britney Spears' dad to look after your money for you. Bloomberg reported earlier this week that investors in these three leveraged ETFs have lost around $1.5 billion in assets since early October. At the peak of the crypto treasury company craze and the leveraged ETFs that loved them, Robin Wigglesworth wrote in the FT about the launch of the Bonk Income Blast ETF with the subheading, "Every day we stray further from God's light." The article quoted an SEC filing for an ETF that would invest in Bonk, the social layer and community meme coin of Solana, with deep integrations as a utility token across a wide base of application and protocols within the Web3 ecosystem. Fortunately, no one has lost money on this one yet, as it's still waiting for approval. But its goal is to buy Bonk call options and sell Bonk put options to generate the full Bonk upside that you would get by simply buying Bonk, but with potentially greater capital efficiency, by generating Bonk-derived income. The prospectus does warn of the potential for significant losses if the price of Bonk declines. Anyhow, copycat crypto treasury companies who are underwater on their crypto purchases have started dumping tokens to fund stock buybacks or to service debt. The FT reported that NYSE-listed chipmaker Sequence sold $100 million worth of Bitcoin to pay creditors just 4 months after pivoting to a digital asset treasury strategy. Its CEO told the press, "Our Bitcoin treasury strategy and our deep conviction in Bitcoin remains unchanged." Metaplanet, Japan's biggest Bitcoin holder, raised a $130 million loan against its Bitcoin stash after its stock fell 80%. Smarter Web Company, the UK's poster child for crypto treasuries, is down 44% and trading at a discount to the crypto it holds. But amidst this graveyard of copycats, there was one hilarious exception: GameStop. When the original meme stock king announced that it was pivoting to a Bitcoin treasury, the stock actually fell 10%. Why did this happen? Well, because unlike strategy, GameStop has an actual business, sort of. It sells video games and Funko Pops to people in shopping malls, not all of whom are also GameStop shareholders. The market realized that if you have real revenue and real customers, you're judged on them. It turns out that the infinite money glitch only works if you're a hollow vessel. If you're empty inside, you can be filled with dreams. If you sell used copies of FIFA 2019 for $4, you're just a retailer with a strangely volatile balance sheet.
What if I told you everything on your computer could be gone at any moment and you wouldn't even realize it? Your passwords, your bank accounts, your crypto wallet, your work files, private photos, all of it, simply because your system is infected.
The entire machine is like a quadratically reflexive engineered instrument. And you could say, well, Michael, you're a financial engineer. Yes, I am.
Strategy, however, has a strategy, sort of. Last weekend, Michael Saylor posted a stock price chart covered with orange dots, which highlight when the company bought its Bitcoins, with a teasing question: what if we start adding green dots? The implication was that he might buy dollars. For a company whose chairman famously compared the dollar to a melting ice cube, hoarding fiat currency is a stunning capitulation. This Monday, the company announced that it had issued $1.4 billion of equity not to buy Bitcoin, but to build a dollar reserve to cover the dividends on its 5 classes of preferred stock for the next 2 years. Now, Michael Saylor does have a point. Issuing stock to raise cash is a lot like issuing stock to buy Bitcoin, but cash has a special use case where it can be used to make payments and even buy stuff, even stuff that's not available on the dark web. At a high point in the crypto treasury company mania in October 2024, MicroStrategy's chief executive officer, Fong Li, explained on an earnings call why they were selling a record $21 billion in new shares to fund crypto purchases. He explained that the dollar amount related to the children's book, The Hitchhiker's Guide to the Galaxy, where a supercomputer explained that the meaning of life is the number 42. He went on to say, "We believe it's a unique number with some special characteristics. It's the sum of 21 plus 21. We all know that 21 is a magical number in the world of Bitcoin. There can only ever be a maximum of 21 million Bitcoin in circulation." An actual CEO said this on an earnings call in all seriousness, and people, actual adults, had to listen to it without pointing and laughing because that would be rude. I needed to be sure, so I Googled him because maybe they actually put a little boy in charge of the company. But here he is on the strategy website, and the AI picture seems to be of a grown man. There was probably an analyst on that call, straight out of Harvard Business School, maybe on his first day of work, turning to his boss saying, "I think we're on the wrong call. I think this is some sort of dial-in horoscope lucky numbers line. You dialed 1-800, right? Not 1-900. We might be being charged for this." He possibly wondered if he was being hazed on his first day at work with a fake earnings call, like the way construction workers will prank the new guy by sending him around the site looking for a left-handed hammer, or getting him to return the 2x4s that aren't 2 inches by 4 inches in dimension. The stock didn't even crash that day. In a normal world, it would have, but over the last few years, a different type of person started investing. So why the sudden love for the dollar? And why $1.4 billion? Is that a children's book reference that I'm not aware of? Maybe it was the number of wands Harry Potter owned in Harry Potter and the Chain of Blocks. I haven't read that one.
You know those Harry Potter books? You know they're for children, don't you? They're aimed at children. The Harry Potter, they're children's books. People go to me, "Have you read the new Harry Potter book, Stu? It's good if you read it." No, I haven't read it, because I'm a 40-year-old man. You should read it, Stu. It's about a wizard in a school. I'm not reading it. I'm an adult.
Well, the thing is that the company has issued preferred stock with aggressive names like Strife, 10% coupon, Strike, 8%, and Stretch, a variable rate currently near 10.75%. These dividends are high, and they mean that the company needs to come up with hundreds of millions of dollars every quarter. For a while, they were issuing stock, not at a huge premium, but Bitcoin was still going up. And if you issue stock at 10% to buy Bitcoin, which you think will go up at more than 10% a year, then that's an accretive trade. But if Bitcoin goes up by less than 10% or falls, then you're still paying that 10% a year to those investors and destroying value. Now, technically, these are dividends, meaning that the company isn't legally obliged to pay them. They can choose to accrue them, but doing this would likely torpedo the company's ability to raise any more capital for quite some time, ending the game immediately. So strategy is stuck. It's now selling common stock to raise cash so that it can make dividend payments to preferred shareholders. Now, when you start raising capital from new investors to pay out old investors, your strategy starts to seem like more of a scheme. As Bloomberg's Matt Levine noted, we're selling billions of dollars of stock at a premium to NAV to buy Bitcoin is maybe a great story. We're selling $1 billion of stock at NAV to pay interest on the loans we previously took out is considerably less fun. For strategy, if there is no recovery in the price of Bitcoin, the real pain will begin in 2027 when the firm's convertible debt starts to mature. Its borrowing right now is modest relative to its assets, but its lack of alternative sources of income may force it to start selling its Bitcoin. So why has crypto been tanking recently? I don't really know. It doesn't really do anything. It's just a number to bet on. It's not even that useful for illegal payments, as things like stablecoins are better at that. So the price of things like Bitcoin just rise and fall based on whether people think it'll rise or fall in the future. It seems to have become highly correlated with tech stocks, but there's no real reason to believe that that'll continue. In 2013, Joe Weisenthal wrote a column called "Gold is a Bet on Human Failure," where he argued that buying gold is a negative economic act because it represents a bet that a shiny rock will hold value better than the collective ingenuity of the human race, represented by stocks and productive companies. He argued that when investors buy gold, they're essentially hedging against total political breakdown and the failure of peaceful human interaction. He has since extended this logic to include Bitcoin, which he describes as an even more profound form of shorting the system, arguing that Bitcoin's appeal is based in a complete loss of trust in state capacity and institutions. The Economist wrote a good piece last month called "Crypto Got Everything It Wanted, Now It's Sinking." In the piece, they argued that the crypto industry has gone from being an object of mockery to being broadly accepted by politicians and regulators. But this victory has created a paradoxical problem. The thrill of the chase is over. Every major rally in recent years was fueled by the anticipation of specific milestones, like the approval of ETFs or the backing of a friendly US administration. Now that those battles have been won and investors have no trouble getting their hands on Bitcoin, the market has exhausted its most potent bullish narratives. Without a new catalyst or a forbidden fruit story to sell the next wave of buyers, crypto is left as a purely speculative asset with no fresh reason for the number to go up. One of the reasons for thinking Bitcoin could go up forever was a belief that Strategy's infinite money glitch would work. My friend Zeke Fox appeared on Dan Toomey's YouTube channel a few weeks ago, and if you haven't watched that video, you should. I'll put a link to it in the description. In it, he explained his juggalo theory of Bitcoin resilience. Zeke argued that Bitcoin has developed a fan base as committed and impervious to outside criticism as the juggalos, the die-hard insane clown posse fans, who dress up as clowns and attend an annual gathering. I should mention that Dan Toomey is a huge ICP fan, so don't say anything bad about them around him. Zeke argued in the video that much like the way you wouldn't bet against the juggalos attending their big meetup every year, you shouldn't bet against Bitcoiners showing up to support the Bitcoin price, or showing up in my YouTube comment section to say that Bitcoin is somehow not the same as crypto. They are a cult, according to Zeke. That puts a floor on the asset price simply by refusing to leave. But Zeke then adds a critical twist to the analogy. Unlike the juggalos who congregate for the love of the culture, Bitcoiners have a powerful financial incentive to evangelize. What if by recruiting more juggalos you would get rich, he asks. If bringing in new fans directly increased your net worth, you would work a lot harder to recruit them, and suddenly the music might start to sound a whole lot better to you. It'll be interesting to see how things work out for Strategy. There's no underdog narrative left to drive the price. There's no institutional wall left to breach. Strategy issued so many convertible bonds that the gamma hedging, where the traders buy the stock when it falls and sell it when it rises, killed the volatility. The SEC is no longer the villain anymore. It's just a regulator, and a regulator run by a crypto guy. The US Secretary of Commerce is a crypto guy too. BlackRock can't be viewed as an enemy either. It's just the custodian. And the US president isn't just on side, he's attained almost all of his wealth from crypto. If there are no walls left to breach, we're just left with Michael Saylor tweeting that Bitcoin is a swarm of cyber hornets serving the goddess of wisdom, feeding on the fire of truth. I'm not sure if that can be classified as a sentence, if it makes no sense, but that's what he said. For now, the cyber hornets are quiet. The premium's almost gone, and the infinite money glitch may have been patched. And Strategy investors have been learning the oldest lesson in finance. Leverage works both ways. The Ouroboros has finished eating its tail, and it turns out it wasn't very nutritious. If you found this video interesting, you should watch my video on AI's circular financing bubble next. Don't forget to check out our sponsor Saley using the link in the description. Have a great day and talk to you in the next video. Bye.
Remember Liberation Day?
Starting tomorrow, the United States will implement reciprocal tariffs on other nations.
It was the day Donald Trump put new tariffs, or fees, on products imported into the U.S. from other countries.
They charge us, we charge them.
Trump assigned a different tariff rate for each country. Goods from China would be charged 34%. Goods from Indonesia, 32%. He charged other countries even more.
Vietnam, they like me, I like them. We're going to charge them 46%. Cambodia, oh, look at Cambodia. We're going to bring it down to 49%.
For many U.S. companies that manufacture products in these countries, these tariffs were very bad news. But for Nike, they were a disaster. Because Nike made almost all of its sneakers and apparel in these countries, it was facing more than $1 billion in tariffs. And because even before Liberation Day, pretty much everything else at Nike was going terribly.
Once a tastemaker, sneaker giant Nike is falling behind.
Shares of Nike are in free fall. Warning of weaker revenue.
An identity crisis.
Nike.
Nike.
Make no mistake, there's a lot wrong here. Nike needs to get its you-know-what together.
Now, you might be thinking, why does one sports company really matter? And I'd say that if you want to understand the 21st century political economy of sports, you have to consider not just the players, teams, leagues, and owners, but the giant billion-dollar companies as well, especially one that's revenue is bigger than a lot of countries' GDP. So what exactly is going wrong at Nike, and is it too late to fix?
If you want to have a job in the next 5 years, these are the AI rules you need to know.
Nike's success comes down to a simple formula. First, it innovated new products. In 1971, Nike's co-founder Bill Bowerman used his wife's waffle iron to make a new running shoe that was lighter and had better grip than cleats used at the time. After making the waffle trainer, Nike signed an athlete to promote it. But not just any athlete. In the 1970s, sportswear was dominated by giants like Adidas, Converse, and Puma. Nike saw itself as the scrappy underdog. Steve Prefontaine was also a scrappy underdog. Once considered too small to be a track star, Prefontaine went on to be a college champion and run in the 1972 Olympics.
He stood for individualism, rebellion, and the pure joy of competition.
In 1973, Nike signed him, then added the final piece to the puzzle, bold advertising. Adidas and Converse's branding tended to be positive and relatable.
Hey, Dr. J, where'd you get those moves?
But Nike was unapologetically about winning. Its name came from the Greek goddess of victory. The swoosh logo was big and aggressive, and Nike's tagline got to the point. This formula eventually won Nike 50% of the US athletic footwear market, so the company used it to expand into tennis. Then basketball, where Nike signed the athlete first. Michael Jordan was exactly the kind of tenacious competitor Nike liked.
Here's a kaboom. What a jam! Here's Jordan down the middle all the way. Kaboom! And that's what they came to see, didn't it?
So much so that Nike designed a new shoe just for him, the Jordan 1s. It violated the NBA's rules that shoes had to be mostly white, but Jordan wore them anyway, and Nike paid the fines. Then Nike put Jordan in its signature ads.
Yo, Mike, what makes you the best player in the universe? Is it the vicious stunts?
No, Mars.
Is it the haircut?
No, Mars.
Money's gotta be the shoes. Shoes. You sure it's not the shoes?
I'm sure, Mars.
Spike Lee directed commercials that were like both at the same time tongue-in-cheek, but also brash, swaggering, arrogant.
Daniel Yaw Miller is a journalist covering sports and fashion.
It really kind of took shots at its competitors. It was unafraid to kind of lash out and also back it up. I think that's the essence of Nike storytelling.
As Jordan went on to become the greatest basketball player in history, Nike grew into the biggest sportswear company in history. Over the next 30 years, the company used this formula to expand into more sports, from soccer to golf.
Here it comes.
It made the swoosh recognizable to anyone, anywhere, and sold its products in nearly every sports store. It wasn't always smooth sailing. In the 1990s, Nike faced criticism for tolerating sweatshops in Vietnam, where conditions were often unsafe for workers. But Nike's stock kept climbing and then started to soar in the 2010s. Nike began designing products with what it called VizTech. It put shocks in the heel of its Nike Shox, air bubbles inside the Nike Air Max.
Which is actually genius for consumers to think I have more bounce because of the air in my midsole. Nike really revolutionized not only like how footwear is made, but how you talk about how footwear is made.
It helped make Nike a $50 billion company in the 2010s. But it was then that Nike would start to stray from this formula at the worst possible time.
Very quickly, I want to thank today's sponsor, and that's Storyblocks. I've been at video. It's unlimited parts.
2 months later, 20, Nike hired John Donahoe, who came from consultancy and tech companies. 2 months later, the pandemic hit. Nike stock jumped as consumers spent stimulus money, then started to slide. Nike scrambled to fix supply chain problems and cut its sales forecast after its Vietnamese factory shut down. This wasn't Donahoe's fault, but it was his decision to change how Nike sold its products. Typically, the company sold to retail stores who sold to consumers. Donahoe decided to pull products out of retail stores to sell to consumers directly, which was more profitable. But it opened shelf space that stores filled with products from Nike's competitors, especially in running. Brands like On and Hoka were innovating new VizTech, especially in the soles, and getting onto shelves helped boost their sales at the expense of Nike's. This was just one mistake. Another was not really innovating anything new.
This Black Friday gift is my favorite dentist hack to clean my retainers. If you wear a retainer every night like I do, you know how hard it is to keep it truly fresh and clean, safe and bacteria-free. I've seen so many of my patients struggle with ineffective cleaning methods like brushes and tablets. These methods...
A number of senior executives and designers were lured from Nike to other brands, which left the company to rely more on sales of older models. It worked during the pandemic, when Nike's retro basketball shoes became very popular. But trends changed, and consumers began preferring low-profile shoes like Adidas Sambas. It left Nike holding excess inventory that hurt its profits, caused sales to tumble, all while its competitors soared.
Regular consumers started to look up and say, like, when I go to the store, I don't really see Nike products that I want to buy anymore. That's when I think like the alarm bells start to go off.
Then the dominoes started to fall. Big-time athletes left Nike for its competitors. Roger Federer signed with On. Harry Kane went to Skechers, Simone Biles to Athleta, and Josh Allen to New Balance. Tiger Woods left to start his own brand. Then Nike changed its ads. It turned its signature aggressive tone more whimsical.
The future is exciting because you never know what's going to happen.
Reframed its message from win at all costs to just try your best.
Here's to going for it and being terrible.
And focused more on social issues.
Maybe your dream.
Partner of the Toronto Tempo, and proud to champion every ambition.
Europa Universalis 5 was released about a month ago, and frankly things have been going significantly worse than how I thought they would be going right now. We're looking at a game that was released in a state in which many of its systems didn't work right, which had UI that really needed some improvement, and yet a game that also was fun, and well, kind of the platonic ideal of a grand strategy game. In my review at the time, I said very clearly that you need to be ready for some pain if you want to love and play EU5 right at launch, is you will be beaten over the head over and over again by bugs, broken systems and complete imbalances. It was a pretty thought out warning, at least I thought so at the time. I was of the opinion that it would prepare both you and me enough to enjoy the game, even with all of those issues. Well, the last month went a whole lot worse than I expected, I gotta be honest with you. In this video, I will tell you about the patches the team delivered, the open betas they started, and why all of that is a bit of a train wreck. We'll also take a look about communication in general, and where I am currently at with Europa Universalis 5. But to make it short, my cautious but optimistic warning about how it would probably take more than a year to fix up the game into a state that isn't gonna have you trip over bugs and other nonsense every time you play was probably too optimistic. Right now, I'm really pessimistic about Year 5, and I think many in the community have been saying to themselves, I'll be back in 6 months, and I can't actually blame them. This has been a mess. But alright, let's talk about the basics. EU5 is an unbelievably complex and big game. That makes it so that, yeah, bugs are of course going to be common. It is difficult as a developer team to understand what the ifs and buts are that you will encounter as you have a full campaign. This means it's expected, kind of, that the game is going to be somewhat buggy. Now, to tackle that though, and that is pretty clear, at least in my mind, you need a very, very sophisticated approach. You need to at all times be in control of what your vision for the game is. You need to make sure that you very carefully test what you're implementing so that it doesn't create 15 more bugs and now you've just made more work for you. And I think you need to communicate what you're doing to the community incredibly well. Because if you don't do those things, A, you're going to get a negative reputation where people simply, whenever they see anything that seems counterintuitive, will say, of course, it's just buggy, even if it isn't a bug, but just difficult to understand. But also people will drop your game. Now let's talk about these initial patches. Like I said, this game is incredibly complex and incredibly big, and I called it the most unpolished game, maybe excluding Hearts of Iron 3. That one literally didn't work. That is the only complaint about that review that I think is a valid one. Hearts of Iron 3 was, yeah, what a hellscape. But basically what I'm saying is, it will take them ages to fix this just because of how significantly more complex this game is compared to most other, if not all other, grand strategy launch titles. This means there's a lot more to clean up, and every time you sweep and squish a bug, there are 3 or 4 more new ones. This is exactly what has happened with this game. But what's worse, instead of being incredibly thorough and really keeping track and really testing things incredibly well, we had such a high cadence of initial patches that everything basically got screwed over 24/7. You would just be a normal player, you would come home, you would want to continue your campaign, and we all know that campaigns in this game take a million years, and then you would realize that of course there has been a patch. Now, if you want to sit down and find out what that patch does, well, in the game it doesn't tell you anything. If you take a look at the actual changelog, it is incredibly vague, and even if you take the time to go through script, well, your evening is gone and you aren't actually playing the game. Look, grand strategy games are incredibly niche. You have people that are a lot more dedicated on average than players in other genres. People take more time, they participate in the community discourse, but ultimately they just want to play the damn game. The reality with these initial patches was that this was the exactly wrong strategy for what they should have done, well, in the first month after release. You need to keep things stable after release. People just want to play the game, they want to see how it is, whether they have a good time. Every time they come home and there's a patch that shoots their playthrough in the head, yeah, it's over. Why would they continue jumping in? Now they need to research whether they need to roll back and to which patch they need to roll back. It sucks. This was obviously completely wrong. Not to mention that these initial patches also simply didn't test things all that well. They were pushed out incredibly quickly. I am not debating whether they fixed bugs. I believe that they did, and I know that they did. I'm not debating whether they were testing it. They definitely were. They just weren't doing it enough. We already had this situation in Stellaris earlier this year, and it was horrendous there. They even said, and I quoted this in the past, that, yeah, QA clearly wasn't able to really check through the patches that they were releasing in Stellaris anymore, so they had to stop that high cadence. EU5 hasn't really done this. We just got patches that fixed some things that weren't clear about what they fixed and that very often rebalanced everything. This would of course naturally result in those patches also needing hotfixes, those hotfixes needing hotfixes, and everything just making more and more bugs. Instead of taking a slow and methodic approach to really kind of figuring out individual systems in the game and squashing every single bug that they can find there, they were doing pretty hot coding stuff. So yeah, the initial wave here of EU5 support was bad. That is my opinion at least. Now I'm interested. If you were one of the players that just wanted to play the game, but then all these bugs messed up your playthrough 24/7 and you didn't want to research what exact minuscule thing changed that you now need to reset or what you need to roll back to, if you're one of them, please make yourself known in the comments. Did you stop playing EU5? Are you just waiting for, you know, a good patch? What are you doing? How are you dealing with this? Or are you just powering through? I think inarguably what they did here was the worst possible approach that they could have taken. What needed to be a very thought through and well delivered initial launch month so that people stick with the game was a haphazard approach to fixing bugs while more and more bugs would pop up as they went forward. Now, they did learn from this, and I want to bring this up, of course. They switched to the model of open betas. Instead of pushing a minor patch directly to the main game and then needing to hotfix it several times, it becomes an opt-in beta. People that play on this patch and experience the bugs, of course, really only see those bugs because they willingly took part in the beta here. Meaning more playthroughs should be safe, right? Running an open beta is also actually incredibly promising because it means that you can get a lot of feedback on what you're doing and, well, you might be able to divert where you were originally going compared to where you end up if you have good player feedback. So things should have gotten significantly better in the patch pacing and the quality of patches once they started the actual program with 1.0.8, right? No. The open beta system for EU5, and I want to be very direct here, is the worst open beta system that I've ever participated in a grand strategy game. Obviously, we have had these throughout the years in several games. Stellaris has been running them, CK3 had one as well for the multiplayer fixes that they did a couple of years back. And then we have Victoria 3, I think most notoriously here, for 1.2 and 1.5, where they ran long-standing betas, got a lot of feedback and implemented it as well. So there's a lot that I can compare this to here. And EU5 is terrible, both in the presentation of the open beta patch, in its dedication to taking in feedback and responding to it, and the general communication of what the plan is going forward. Now, before I go into this and kind of talk about what is being messed up here and why I'm super tilted about it, I really am super tilted about it, just to be clear here, I want to bring up one thing. I don't know why things are going this way. I have no idea, and I don't want to speculate. That's not really my place. All I can say is that when you release a game in November, you basically have until mid-December, because then Christmas holidays come around. Many people in the office or wherever they are will probably be taking a couple of days and weeks off, and then you will come back into the office in January, which means end of December isn't going to be all that productive. Your most productive period was essentially November, and I think they've completely squandered it. So, what is wrong with these open betas? Well, let's take a look at some open betas that were run really well. The Crusader Kings 3 open beta for multiplayer, for example, wasn't about design. They didn't want us to critique how their infrastructure works, they just wanted to have reports. But that still meant that they needed a particular forum section where only this open beta would be able to give feedback, making it so that it's very clear, hey, you're testing this right now, and we know you are testing this right now, meaning whatever you're giving us lets us fix what we're doing right now, rather than this is just a random bug that you discovered 5 versions back. If you are doing an open beta that is really small in its scope, like just changing multiplayer to actually be workable, you can do this, that is completely fine. Victoria 3's 1.2 and 1.5 open betas are great examples for what you should and have to do if you are in a position where you want to do something more wide-ranging. Let me explain to you how the open betas in Victoria 3 went. These open betas were very wide in their scope. A lot of things were to be changed and a lot of things were to be considered. This meant that there needed to be a really big and sophisticated process in taking in a mass wave of feedback, segregated from feedback for the current game, so not the open beta, just the released version, and then actually turning that into something that is in the game. The way the Victoria 3 team handled this was by being incredibly transparent. They released dev diaries exclusively detailing what kind of feature designs they had added to the open beta, what the working as design status was. If you don't know, working as designed literally just means this is the feature as we envision it, and if it works the way that we describe, it is working right. If it is working any other way, it is not working as designed, and that is essentially a bug. They detailed all of this stuff and made it very clear what would be coming. Simultaneously, as they launched the open beta, they also detailed what they knew were issues that were currently in the game. Things that were missing, things that were broken, things that they didn't yet had time to implement. Once the open beta started, they gave us incredibly long changelogs. Every update for the open beta, they gave us incredibly long and detailed changelogs as well, so that we would know what had changed and would know what we could actually evaluate. And then they were in an incredibly work-intensive, and I want to be serious here, this must have been exhausting, an incredibly work-intensive period where both the developers but also the community team was constantly monitoring the feedback forums. This meant you could leave really long feedback and then at the end of the day would be certain that it had been seen, because it literally got something that said has been seen. They took a lot of time to explain the concepts, to talk to the community, to consider what the complaints were, and then implemented it as they went. As far as I know, but maybe I'm wrong about this, I believe also that the community team was incredibly busy detailing what exactly the fan feedback was and turning it into actionable bullet points for the developers. All of this was one of the greatest experiences ever, because it meant that the final result of all of the reworks they were doing came out as polished and as well designed as possible, compared to if they had just worked this on their own time or if they had pushed this out as a normal patch and then had to hotfix 15 times. So, that is how Victoria 3 did it, and I would call this the golden standard for Grand Strategy open betas. It meant we were always in the know what issues we would encounter and we could give valuable feedback. So then how does this compare to the EU5 open beta? Every single overview that they gave us on the changes that they were making in the open beta were incredibly vague, not at all going enough into detail. I have seen the community in the last weeks engage in divination and tea leaf reading to understand what the actual intention of this is. The most notorious change, of course, being centralization and decentralization. It was a massive shift, now making it so that the ideal step at the start of the game is to virtually always go decentralized and go centralized later. Is it good gameplay? Is it good design? What exactly does this simulate? What is the point? We don't know. Okay, maybe they at least provided really detailed changelogs, right? Well, I mean, you already know, of course they did not. The changelogs are incredibly vague. It's super frustrating because what does any of this mean? Is it good? Is it bad? Where is it going? What's the intention behind making these changes? And what even are these changes? I have no idea whatsoever. Alright, but what about feedback? Can we at least give good feedback? Well, it's kind of twofold, right? First of all, we physically cannot give good feedback. I've said this on other platforms as well. Other people have said it also. The fact of the matter is, if I don't understand what the working as designed stage of this feature is, how can I possibly say, hey, I like this as a design feature, or I don't like this? I'm not even sure that it's working right. And even if somehow, miraculously, I put in all the work to now understand whether, hey, does the change to economic base, does the current balancing of the military, for example, does all of that make sense on what is the game vision of the developers, where are we headed here? Even if I had all of this, there is no dedicated forum where we are just there so that somebody can collectively gather all of our very concise feedback and deliver it to the developers. We are looking at the Wild West, and it has been incredibly counterproductive. So the result is that the first open beta for EU5 ended, and it didn't exactly feel like there was any significant dialogue between the developers and the community. That's okay, I guess. At the very least, we get more stable patches for the people that literally just play stable patches. But even then, the open beta is relatively useless because we can't really do more than the QA because we have no idea what the game wants to do with these values. Where are we right now, at the start of December, when it comes to the video game that is called Europa Universalis 5? Well, combat is a bigger mess than ever before, with cavalry regulars being stronger than ever before and wiping out literally everybody. There is no reason other than for fort reinforcement to bring infantry in the first place. Obviously the AI doesn't know about this, and obviously this isn't intended, but combat has been completely screwed for a really long time now, and every time that they try to address it, they added more really confusing modifiers that, quite frankly, I've given up on understanding. All I know currently is that levies are a complete waste of time, which obviously isn't how it should be. We are also still in a state where most of the situations and international organizations that didn't work at launch are still not working right. The Western Schism is incredibly buggy. The Guelphs and Ghibellines also buggy. The Holy Roman Empire is without a doubt in the current open beta in the worst state it has ever been in. They don't even pass the Golden Bull. And to be clear here, they didn't really do much before that either. The AI always just passes the worst option, Holy Roman Figurehead, which supposedly has been fixed, but I couldn't tell you, because it doesn't work right in the open beta. Not to mention, of course, that they all still just vote yes on everything, meaning a player Emperor has a really easy time playing in the HRE. Simultaneously, the Treaty of Tortillas is completely bugged, as it has been since launch. Conquistadors, completely bugged. Trade companies, completely bugged. I don't know what to say, other than that the constant reworks, where we as a community don't even know what the idea of the reworks is, leave all of the bugs still in the game and the reworks not exactly achieving what they needed to achieve. If you're listening to this and you're saying to yourself, wow, he's being incredibly harsh, the answer is yes, I am being incredibly harsh, because at the current pacing, we are not really seeing the improvements that we needed to see to existing gameplay systems on a design level, right? So reworking things like, for example, taxation or the military, but we're also not seeing the bugs that really matter squashed. This game is incredibly buggy, and with the haphazard way of improving it right now, it's not going to go anywhere anytime soon. Now, the last thing that I want to talk about here when it comes to the open betas is that I am also deeply disappointed with how the open beta has handled its feature design. Sure, they don't tell us about it, but even then, the features that are being added, I mean, I don't think I needed to open beta test this for it to become obvious what the issues are. So I feel like I'm constantly just talking about the base issues that should be apparent by the time this feature is designed. A great example for this, and I want to stress here that this is something you will encounter for many of the new features added in the open betas, are the changes made to vassals in the 100 Years' War. They added now an interaction, or rather a decision, that the vassals can choose where they can literally defect. They become, for example, from a French vassal into an English vassal. The ability to do this and the willingness to do this are governed entirely by the subject loyalty and whether they are in Europe. Now, the obvious implication here is, what is that? Because it means that, for example, Wales can now all of a sudden switch over to France. This is completely nonsensical, because this kind of allegiance switching did happen, but it happened with vassals in France, because what they were doing was recognize the King of England as King of France. It shouldn't be happening with anybody else. They already said now to roll this back, but I also have to tell you, I also witnessed
Micron is taking money from the American people under bipartisan support, and it is then fucking those people over by killing its consumer-facing line of memory, with its mega corporate buyers getting priority over the forlorn consumers who themselves footed the bill to pay for their own economic destruction. What they can also do is continue processing your daily computing needs in those data centers while making the hardware impossible for you to buy because you can't fucking afford it because they bought it all. That's where I think this is going. The corruption of the silicon companies is in the open. Micron is in the news for abandoning consumers, but this is bigger than that. The cartel of silicon manufacturers have continued to rake in record tax breaks, government subsidies, and taxpayer money from a populace battered by the unaffordability of basically anything and by rising prices. And all of this is to pass on that money to the manufacturer's own mega corporate customer manufacturers, all praying to their god of money, AI. So while normal people are feeling the walls closing in around them as software as a service looms from data centers hoovering up all the affordable hardware, signaling the end of an era for affordable home computing, all of the eggs are in the AI basket for Micron, which just killed its direct-to-consumer RAM to focus on the bubble of AI. Quote, the AI-driven growth in the data center has led to a surge in demand for memory and storage. Micron has made the difficult decision to exit the crucial consumer business in order to improve supply and support for our larger, strategic, more important, no, it doesn't say that part, customers in faster growing segments, end quote. For consumers, the end result is higher prices on already high prices, less competition in the consumer market, and critically, less pricing suppression coming from a first-party manufacturer of the memory itself, one of 3 that are relevant in the world, and they've just killed their store brand, basically like a supermarket house brand of memory, which was called Crucial. At times, this former consumer-focused brand of Crucial meant that there was more competitive pricing than some of the customers of Micron, who buy Micron memory and glue it to their own self-branded heat sinks and sticks alongside the likes of SK Hynix and of Samsung. Those 3 collectively form basically the entire market for this supply. This seemingly panicked decision comes just 8 months into the craziest of the AI demand. We question whether Micron is actually killing this for the stated reason of excessive AI demand requiring more chip supply, as opposed to retconning a reason, and AI washing its closure of the business unit Crucial and inevitably getting rid of a lot of the staff who probably worked there. But then, if you look at Micron as a whole, they're actually doing pretty well. So maybe they're not AI washing a bad quarter. Micron is actually doing amazingly as it capitalizes on the destruction of the consumer market and works with data centers to suck in all of the hardware to continue to move computers and the ownership of them into the cloud for software as a service models. Micron's stock started the year at $87.33 and peaked at $253.30, a climb of 190% to that point. About 2 weeks ago, Micron's stock suddenly plunged to $201, but that was still up significantly on the year. As we write this, the end of trading after its announcement had it at $234. Again, that's from 87 on January 1st. For even more perspective, switching to the maximum scale shows us that pre-COVID Micron stock was around $40 to $50. As for why we're talking about the stock price, it's because it's the only fucking language these people understand. The executives don't know anything else. To them, this is a job well done, even though we're barreling towards the end of easy ownership of computers at home. High-end computing in the home has been democratized by prices, and that is starting to go away in a very serious fashion. These greedy companies with NVIDIA CEO Jensen Huang at the helm, while he shoves his hand up the US government's ass for his next award-winning puppet show, are doing their best to de-democratize silicon and pull it out of the hands of the consumers to shove it into their data centers. And just if you don't know, Micron is a supplier of VRAM that goes into GPUs as well. We think the end game here is that they'll charge you to use this stuff in the cloud. If you want 128 gigabytes of RAM on a computer to run a calculation, but you can't afford the 250% higher price, then good news, you'll be able to rent it remotely for just some money every month. Forever. We're actually working on a deep dive into the DRAM cartel right now because our AI Dystopia Kickstarter style campaign on our store hit our stretch goal, which means the DRAM cartel coverage will join our series of upcoming reports on the reckless expansion of data centers and AI companies. You can join to support our campaign and coverage series at store.gamersnexus.net, where our various backer tiers include things like our censored speech Vaporwave smiley t-shirt, our new retro IO themed drink coaster packs, in some of the tiers with soft rubberized material and unique component theming, and all backers will even get a USB copy of some of our upcoming videos on a physical 128 gigabyte USB drive, just in case we get Bloomberged again. Although if we do, we also have our video unavailable t-shirt. Other backer rewards include bonus videos, a small group Q&A session with me in the highest tier, and a signed mouse mat for that one. We're still putting together our deep dive into the memory industry, so check back for that. For now, head over to store.gamersnexus.net to support our upcoming series that we're launching in multiple videos over the next 3 months. We're gonna have some pretty heavy commentary towards the end here today, but we'll start with the basics and the statement. So Micron is one of just 3 relevant global suppliers for memory. It's Samsung and SK Hynix in South Korea and Micron in the United States. These companies sell their DRAM and their flash components to other companies that you might be familiar with, like Corsair, G.Skill, Kingston, Team Group, and so forth. Memory suppliers have previously been convicted of price fixing and of fraud. And this has been attempted again in the time since, but it goes back as far as decades ago now. These days, they've fixed that problem by not colluding to fix prices, by instead doing it publicly. So it's not like a private behind closed doors price fixing agreement and a handshake between CEOs now. Now they just talk about it in their earnings reports. So other than these 3 suppliers, the entire rest of the memory industry is made up by less than 6% of other companies as of a couple years ago, and probably even a lower percent for that other category now. Before we really tear into this, let's read the full statement from Micron. Quote, Micron Technology, a leader in innovative memory and storage solutions, today announced its decision to exit the Crucial consumer business, including the sale of Crucial consumer-branded products at key retailers, e-tailers, and distributors worldwide, end quote. Just to jump in for a second here, but corpo PR spin starting with, we're leaders in innovation, and ending with, so we're giving up. What did Jensen Huang say?
Clever, I guess.
That's it. Now, as we read this next paragraph from Micron, it's important to remember that Micron is an NVIDIA supplier. Quote, the AI-driven growth in the data center has led to a surge in demand for memory and storage. Micron has made the difficult decision to exit the Crucial consumer business in order to improve supply and support for our larger strategic customers in faster-growing segments, end quote. And this was a subquote by Sumit Sadana, EVP and Chief Business Officer at Micron Technology, who again says that the plan is to focus on faster-growing segments. So first of all, fuck you. And secondly, at least Micron is clear with their intentions, which is that Micron doesn't care about consumers anymore. They only want to sell to the big companies in the high-growth AI space. Now, you might be quick to point out that Micron didn't say anywhere in this press release that it stopped selling consumer memory completely. They said they're killing Crucial, which is their house brand of memory, the sticks. And the plain English interpretation of their statement is that the consumer segment is not fast-growing enough, and quote, strategic customers in faster-growing segments, end quote, is the focus. To us, that doesn't just mean Crucial. It indicates anyone in AI and data center getting priority over even their other customers. To us, this signals a drawdown in supply for consumer in general from Micron. And remember, a lot of the price-fixing problems and illegality are solved by not doing it privately and behind closed doors, but instead announcing it to your competitors. And just to be clear, I'm making this point purely for purposes of illustrating a literary point on historical context, and I'm not actually suggesting that they are actively price fixing or committing fraud. I am not suggesting that any of the memory manufacturers are actively committing fraud. That is not what I am suggesting. I'm just making a point about the past where there were convictions of fraud, but I'm not suggesting that's happening now, okay? All right, let's move on. Here's the rest of the spin. Quote, thanks to a passionate community of consumers, the Crucial brand has become synonymous with technical leadership, quality, and reliability of leading-edge memory and storage products. We would like to thank our millions of customers, hundreds of partners, and all of the Micron team members who have supported the Crucial journey over the last 29 years. This decision reflects Micron's commitment to its This decision reflects Micron's commitment to its ongoing portfolio transformation and the resulting alignment of its business to secular, profitable growth vectors in memory and storage. By concentrating on core enterprise and commercial segments, Micron aims to improve long-term business performance and create value for strategic customers as well as stakeholders, end quote. So once again, as if to dismiss the 3 spin doctors that we've seen on Reddit, Micron clearly states that it is concentrating on enterprise and business. The rest of the statement reads, quote, Micron intends to reduce impact on team members. Just clear, not eliminate, they say reduce impact on team members due to this business decision through redeployment opportunities into existing open positions within the company, end quote. Now, we already covered a lot of what's happening in the DRAM industry and in system memory with our RAM What the Fuck video. So again, if you've been wondering what's been going on with RAM, specifically the fuck, then we'll link that video below. The quick recap is that in some instances, within a span of just about 14 days, we saw kits of memory skyrocket in price by double-digit percentages. In a span of about 30 to 60 days, several kits of consumer memory launched upwards in price by 150 to 200%. That has continued to go up in the couple weeks since our report. Checking Crucial's 32 gigabytes or 2x16 gigabyte kit of DDR5 6000 CL36 memory, we found this price trend chart from PC Part Picker. About 120 days ago, this kit was $85 at Best Buy and B&H Photo. By October 20th, that had climbed to $122 and retailer Adorama lost supply. By November 3rd, it increased to $182, so 114% from our reference point. As of today, it's $274. This RAM was $85 just 120 days ago. That's a 222% increase in price in 120 days, or in other words, an average of 1.85% per day increase. This 128 gigabyte kit was $300 and is now $964 at Best Buy and B&H, an increase of 220%. Or if you prefer, a 3.2x increase. This is something a home workstation user might have relied upon for things like CAD engineering, Blender, video production, 3D modeling, game development, whatever. Now it's moving away from solo operative affordability and back into the realm of only corporate buyers. And it's not alone. This kit of 128 gigabyte DDR5 5600 was $420 and is now the result of smoking it at $1,000 on Newegg. And on the affordable consumer side, this kit of 32 gigabytes DDR5 5600 CL46, basically some of the worst memory you could buy, was $83 and is now $261, or an increase of 214%. This Crucial Pro OC DDR5 6000 CL36 kit was $90 and is now $300, up 230%. This kit was $43 and is now $118, thoroughly screwing the consumer of lower-end budget parts. And that's without getting into laptop SO-DIMM memory, where Crucial is a prevalent and had been an important force. These companies are fucking over normal people. It's been happening for a while now, yes, but not like this. Now it's in the open. The corruption of the silicon companies is in the open. In our opinions, not only is our technocracy wrought with what we think is open corruption and conspiracy against consumers to consolidate and move this computing power into data centers and so-called AI, but also open with the United States government. Now, this story started about Micron, but it's sort of about everybody in the industry. NVIDIA reportedly gave $10 million to the Trump ballroom around the time it was in discussions about its export-controlled GPUs. That's without getting into its nearly $4 million in lobbying, such as for AI lawmaking, which, again, AI is where Micron is focusing. Intel CEO got cucked by the president when he was publicly mocked and ridiculed, and just days later sold 10% of the company to the United States government as if through some kind of public humiliation fetish. AMD CEO Lisa Su has joined other tech billionaires like Gates, Zuckerberg, and OpenAI Sam Altman in frequently joining US government meetings to make decisions that we think fuck over the little guy next. Micron is just the next step in all of this. They write their press release in just the right way, where a few corporate bootlickers can defend them on Reddit by saying technically they're only exiting the crucial memory business and not consumer as a whole. But their motives are clear, and they're not really hiding them. We bring up the government because Micron has facilities in the United States, and they are frequently name-dropped on White House press releases. In June of 2025, the White House boasted of Micron's $200 billion of planned investment into fabs and R&D, such as in Idaho, where Micron says it's investing billions in domestic R&D. Micron said it's working on a mega fab in New York, further stating it intends to produce 40% of its DRAM in the United States. Micron chairman, president, and CEO Sanjay Mehrotra stated, quote, "We are grateful for the support from President Trump, Secretary Lutnick, and our federal, state, and local partners who have been instrumental in advocating domestic semiconductor manufacturing," end quote. And in the year of 2025, the PDA displayed between Micron and the US government would probably require an ID to view in 25 states. In fact, that Micron press release included quotes from CEOs Satya Nadella of Microsoft and Jensen Huang of NVIDIA, with the only difference being who's shoved their head up the ass of the government versus who has their hand up it. All of this might be because Micron took $275 million in additional funding from the United States government, part of the CHIPS Act disbursements that were promised under Biden and have continued to go out under Trump. In its latest 10-K form, Micron said it had received up to $6.4 billion in CHIPS Act grants across 2 administrations. Micron even gets local and state tax breaks, reportedly worth up to $2 billion on construction materials and property in New York alone, while normal people struggle to pay property taxes on their homes. Micron spends millions of dollars on lobbying, including more than $4 million in 2022 during the Biden administration and $3 million in 2025 during the second Trump administration. This year, Micron lobbied for higher manufacturing tax credits, which passed as a part of a federal spending bill and increased an investment tax credit on advanced semiconductor manufacturing from 25% to 35%. Micron CEO was gleeful, given the huge jump. Micron actually has paid tribute to the government a lot recently in exchange for tax breaks. Micron donated $1 million to the Presidential Inauguration Committee in January and gave an undisclosed sum of money for the new $300 million White House ballroom. Now, on the day when Micron killed Crucial, Micron's CEO met with the Secretary of Commerce to talk about, presumably, the American AI tech stack. Micron's exchange of government favors has spanned both the Biden and the Trump administrations. The point is, it doesn't matter which of these presidents you hate the least or which one you think is the sleepiest. At the end of the day, Micron is taking money from the American people under bipartisan support, and it is then fucking those people over by killing its consumer-facing line of memory, while also, we think, failing to pay its fair share.
Presenting Odd Pieces.
That looks so cool. What is it?
It's a new kind of puzzle.
I've played puzzles before. Lots and lots and lots of puzzles.
This is different.
These subsidies from the government to build fabs and do R&D come from taxpayer money. Look, if only out of the proportionality of the impact, and not because these mega corporations rarely pay their fair share anyway, this money is being taken from the taxed people of the United States, passed through the US government, and into one of a triopoly of mega corporations that controls an industry. It then is passing on that consolidated power into the hands of the even fewer, with its mega corporate buyers getting priority over the forlorn consumers who themselves footed the bill to pay for their own economic destruction. Micron is just a microcosm here for what's happening right now, which is a reverse Robin Hood. These companies are taking from the many, and they're giving to the even fewer to then take from the many again, and circulate that money in a giant fucking circle like we talked about on the GNCA channel. All of this is without even getting into SSD prices. For those who don't know, the fabs responsible for manufacturing the silicon found in memory sticks often are the fabs that manufacture flash for use in solid-state storage devices, which are in anything that can retain non-volatile data, like your phone or your computer. So it's no surprise that this industry is next. Crucial's SSDs have started to reflect pricing changes already. The T705 2TB drive was $200, and just after the announcement, it skyrocketed to $265. The T500 was more widely available and was $150 on Newegg, but is now $190 on Newegg and $250 at Best Buy. Although some SSD prices are still stable, like first-party supplier Samsung's 1TB 990 Pro price or its 9100 Pro price, some of the companies buying supply are increasing prices. MSI's 1TB M480 went up from $65 to $90, an increase of 38% in 120 days. In case that was a fluke, Western Digital's SN8100 2TB drive has started to show a climb in price, now $250 from $220 120 days ago. Teams G50 has gone up to $200 on Newegg, up from $106 3 months ago. The PNY CS900 2TB SSD, that's highly ranked on Newegg, is now $153, up from $100 3 months ago, a 53% increase. The memory industry has been described as a, quote, cartel by prosecutors and by the justice system decades ago. And that's interesting, because the government has made clear what it thinks should happen to cartels. But there's one kind of cartel that doesn't get bombed from orbit: corporate. And in our opinions, they're still acting like a cartel. That's what we think. For this particular kind of cartel, it seems the bipartisan decision is to shovel as much money into it as possible. That money may have come from taxpayers using unmaintained infrastructure and struggling to pay for healthcare. But as long as stock line go up, everything is according to plan. And frustratingly, these facts have pretty much always been true throughout the entire existence of a taxpayer-funded economy. It's not news. But what feels particularly bad about this one is the fact that, in the very least, for normal people, it felt like it was money being given to a company that would at least sell its shit to consumers and hopefully help create a competitive market in the system that we have. And now they're saying they don't care about that anymore for at least their own division. Memory is in everything. In a recent report from South Korean publication SE Daily, one line of Samsung phones was cited as having its memory cost doubling, which will be passed on to consumers. You don't even have to build gaming computers to notice the memory pricing impact. The memory industry's changes will be felt by everybody. Micron abandoning consumers is just a literal manifestation of what's already happened silently. Anyone who buys a phone, a refrigerator, a car, a smartwatch, a smart lock, a computer, a laptop, a tablet, any of these things that have memory in it, you will be affected in some way by the price. This will be universal for basically anyone who buys modern electronics. All of these things will be affected by the memory industry as it abuses its consolidated power to chase the illusory promise of a two-lettered intelligence. There's no high note to end on here. There's no positive side to this. There's no optimistic outcome of what Micron and these other companies are actively doing and we think conspiring to do. Micron is the first of many to signal its abandonment of normal people. This isn't just about consumers now. Like, this is stuff that everybody needs in their daily life if you're living in any kind of modern society where you might need to interact at some point with an electronic device. And if you're someone who uses electronics, this is going to affect you, and it will do so increasingly. We are at the point, I think, where it's beyond simply just moving software like Adobe Photoshop to a cloud-based system so you can't buy it anymore, you have to use a license indefinitely, and now moving everything into those systems. They call it AI today. And today, that's what they're chasing. It's LLMs and whatever the fuck they think that's going to do at the end of the road for when AI becomes profitable for these companies. But if that doesn't work out, or in the event it actually does and they want to substitute more revenue in there, then software as a service remains a viable option for data centers. That's what they're set up to do. So they might process a search query on ChatGPT today, or a request for ChatGPT erotica from Sam Altman himself in the future, but what they can also do is continue processing your daily computing needs in those data centers while making the hardware impossible for you to buy because you can't fucking afford it because they bought it all. That's where I think this is going, and it is infuriating to see. There's no positive I can take away from this. I think the only lever consumers have that they can pull us to stop buying. But it doesn't work that way. Like, organizing a boycott is difficult, rarely has successes, and people still need this stuff to live. So it's not always an option. It's not that simple, especially considering the greedy data centers are happy to buy whatever you don't. They don't care. All the money's imaginary anyway. It's all investor money. It flows in a circle. So it's going to be there for them, whether or not it's there for you. That's all we have to say about this one. You can support us on the store. Go to store.gamersaccess.net if you want to support our AI Dystopia series of coverage coming up. Subscribe for more. Thanks for watching. Sorry to deliver the news. This is fucking... All right, we'll see you all next time.
We had lost touch with the younger generation. And a lot of the questions I got when I started was, is Ralph Lauren still relevant?
For years, Ralph Lauren leaned heavily on discounts and overexpansion, eroding the exclusivity that built its name. But in recent years, the company has worked to overhaul its strategy and win over a younger generation. Now, the brand is back in the cultural spotlight, from the US Open to elaborate fashion shows and even a viral Taylor Swift dress moment.
So Taylor Swift's dress she just got engaged in is on sale from Ralph Lauren for under $350 right now.
For the first time in nearly a decade, the company's revenue topped $7 billion, and growing segments like women's apparel are taking off.
56% of our shoppers in stores online are actually women.
And now, Ralph Lauren is looking ahead, experimenting with AI.
If we can figure out how to do what we do better with the aid of technology, fantastic.
Here's how Ralph Lauren pulled off one of fashion's biggest turnarounds and what it takes to stay relevant in a rapidly shifting luxury market. Here on Madison Avenue sit two of Ralph Lauren's most iconic flagship stores. The sprawling retail locations carry men and women's polos, sweaters, and other preppy mainstays the brand is famous for, alongside growing segments like handbags, outerwear, and luxury home goods. Since taking the helm in 2017, CEO Patrice Louvet has doubled down on Ralph Lauren's roots while expanding into new categories and rethinking the retail experience. Well, let's talk a little bit about the branding, because here we are in the mansion. It's opulent, it's luxurious. It could seem exclusive, but in fact, it is welcoming. So can you tell me a little bit about how the company manages that balance of being luxury and high-end, but without being, you know, unfriendly?
Well, Ralph's philosophy from the beginning has been this concept of inspiring the dream of a better life, irrespective of where you come from or what your income level is. And so our price ranges today go for, you know, a pack of tennis socks that might be $15 all the way to, we recently sold a $320,000 watch. We want to create an environment that's aspirational but engaging and inviting. Right, and this notion of inclusive luxury is really important to us. You have 15-year-olds coming in here, and you have billionaires.
But Ralph Lauren's luxury empire didn't start this way. In 1967, from a small office in the Empire State Building, Ralph Lauren launched Polo, wide, colorful neckties that stood out in an era of thinner styles. Over the next 2 decades, Ralph Lauren branched into full men's and women's collections and created cultural touchpoints like outfitting Team USA. By the 2010s, the company was stretched too thin. Ralph Lauren was suffering from brand dilution, with excessive discounting, multiple sub-brands, and an over-reliance on struggling department stores. By 2018, revenue had fallen more than 16% in just 2 years. The Ralph Lauren story was growing by leaps and bounds for years, and then one could argue it overextended itself. What was your feeling about how to address that?
Yeah, I think it happens to a lot of companies across industries. All right, great success, high expectations of continued great success. And when there's pressure like that, there's a temptation to broaden distribution. There's a temptation to increase promotional activity. I think of it as the boiled frog phenomenon, which is you say, oh, just do a little bit more. It'll be fine. It won't impact us overall. But as you do more and more of that little bit, ultimately you're damaging the brand. Our challenge was here in the US, where we went too broad, we were too promotional, and we had to pull back. And yes, it's painful, but it's mandatory.
Now, Louvet is steering Ralph Lauren into an era built on brand elevation. In recent years, the luxury brand has sharpened its focus on core products, attracted younger customers, improved the shopping experience, and pulled back from its heavy reliance on discounts and wholesale. So far, it appears to be working, with margins rising and revenue at a 9-year high. How did you get young people on board with this brand?
And we did a lot of work to understand what was relevant for that younger generation, where they wanted to shop, how they wanted to engage, which values mattered most to them. And what we're finding is the Ralph Lauren values of authenticity, family, optimism, quality, timelessness, those resonate with that younger generation. And they resonate with that younger generation here in New York or in Shanghai or in Milan.
Ralph Lauren reinforces those brand values through experiences, from in-store coffee shops designed to draw in younger shoppers, to long-running sports partnerships that spotlight the brand.
Ralph's partnership with the US Open started 20 years ago, Wimbledon, Australian Open, Olympics. So if you look at where we are now, what we're finding is we want to celebrate what's on the court, but actually the thing that's most interesting is showing style in the audience, or the fans, and how the fans dress and how the styles vary.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44.
Beyond sports, Ralph Lauren's shows continue to lean into spectacle. The 2024 Hamptons show turned equestrian stables into a runway, with supermodels Christy Turlington and Naomi Campbell walking before a celebrity-packed crowd. At the same time, Ralph Lauren is ramping up marketing and sharpening its retail strategy. In 2022, it singled out 30 global cities as key markets. It's fueling that push with its largest ever marketing budget, over $500 million. There are a lot of cities in the world.
There are.
And a lot of cities that have a lot of shoppers. 30 only hits, obviously, a very small portion of it. What's the rationale for that?
I think our experience, and when you look at the industry, is when you overextend yourself, you end up diluting the brand, you end up diluting your resources, and therefore you end up diluting your performance.
Yeah.
So listen, we're not here for another quarter, we're not here for another 3 years, we're here for another 50 years. So we got plenty of time to go hit the other cities in the world.
Yeah.
China, for me, is a wonderful example. I think there's still a lot of growth to be had in Shanghai, Beijing, Shenzhen, Chengdu, Taipei, Hong Kong, right? Those are massive cities, tens of millions of inhabitants. Once we feel like we're fully established, then we'll continue to drive that business, and then we'll start to open the white space.
Yeah.
You dilute yourself, you might see the benefits short term, but ultimately it impedes your ability to perform consistently.
Clothing and fashion, by definition, there is the risk of misfires. Tell me a little bit about, for you, where's the balance between not playing it too safe, but also not going crazy with wild stuff that could flop?
So we have the benefit of decades of
Hello everyone, and welcome back to my channel, where here we enjoy nothing more than high quality plastic miniatures, painting up those miniatures as best we can, and also disgusting, soggy, wet trench pilgrims and demons from hell, all wrapped up in a gruelingly grimdark fantasy setting. And if you also like those things, then first of all, okay then, and second of all, you are in luck, because Trench Crusade has recently announced that they are releasing actual plastic miniatures for their game. Yay! And even though it's only been 1 year since I made my first Trench Crusade,
I wanted to give you a little peek behind the scenes into the trusty analytics dashboard. A very typical video for me gets like 100,000 views in the first week, around 1,000 comments, and a like to dislike ratio in the neighborhood of 98 or 99%. This is a nice, comfortable zone for me. It means I'm reaching my usual audience, people who generally understand where I'm coming from. Well, the recent video I did on the Vegas loop appears to have broken containment because it's got like an order of magnitude more views, which is fine, but along with that, thousands more comments than usual and a significant number of viewers who decided to smash the dislike button. What all this means is I absolutely had to go through the entire comment section to try to wrap my head around exactly what happened. So today I'm going to go through the most upvoted comments, really useful comments that brought up aspects of the Vegas loop that I omitted from the video, comments I just thought were funny, and most importantly, lots and lots and lots of comments from haters.
Whichever one you fall in love with, it's always Ristorante Pizza.
And immediately you might be wondering, how can you dislike a guy who sits in a room in a button-down shirt with a lapel mic, talking in a monotone voice to the camera? Well, you're gonna find out, but first let's get to the comment medal stand, the most liked. Bronze medal. I had literally no idea that the loop was in fact just one single tunnel both ways. Holy f***, LOL. Okay, not completely true, which I was hoping I made clear in the video. There are two tunnels, one for each direction, within the convention center, which is the busiest part of the system. But yeah, the other pieces that are opening, as this thing gets built out at an extremely slow pace, are pretty laughable. Silver medal. Having to wait in the shadow of the monorail is almost cartoon level irony. Glad it's appreciated, but I still feel really bad for this family. And topping the metal platform, having a job driving a Tesla in circles underground in Las Vegas actually sounds like hell. And I'd say at least they're getting paid. A significantly worse circle of hell, in my opinion, is paying to ride in a Tesla that goes in circles underground, but having to wait 15 minutes for it to show up on a 100-degree day in the meager shade of the Las Vegas monorail. There are lots of people confirming that they had the same experience I had trying to use this farce while they were down in Vegas. I had my wife take it and walked to meet her at the other end. I had to wait for her. Now I'm kind of obsessed with the idea of people race walking against the Vegas Loop. The city was promised a 155-mile-an-hour technological marvel, and instead they got something that's slower than walking. By the way, reading the comments is how I find out that people who are much more successful than I am actually watch my channel. I found out Chef Kenji Lopez-Alt watches my channel when he left comments on my Pike Place Market video a couple years ago. We kind of stayed in touch and we ended up meeting up there a couple weeks ago and doing some filming, so I've got a whole food urbanism mashup video coming soon. Anyway, Cat Black loved the Vegas Loop video. She's got a check mark. I bet a lot of you all actually watch Cat's stuff, but I had to do some research. Diverse commentary for introspective hot people. I'm kind of 0 for 3 on diversity, introspection, and hotness, so I'm not sure what I'd be bringing to the table in a collab, but probably needs to happen. My favorite genre of comment was probably people who have better ideas about what we should actually be using the tunnels for once the Boring Company inevitably goes belly up. Just run 8-person golf carts, lease the whole thing out to the Haunted Mansion Imagineers, the world's premier subterranean bike path network, the ever-popular what if we kept the tunnels but put 2 pieces of parallel metal on the ground so you could run a high-capacity vehicle on them between stations without needing to steer it. And my favorite, just expand the monorail and the bus system. Also, one thing I appreciate is when someone just goes straight to the heart of it and states things bluntly. Wild to me how we've just absolutely abdicated the entire purpose of government, top to bottom. Probably the most common type of comment I got was people being shocked that the Vegas Loop isn't driverless. I guess you all had higher expectations of the Boring Company than I did, but I get it. I mean, I'm guessing that the Vegas Loop carries fewer people on the average weekday than the driverless Atlanta Airport People Mover carries in like 2 minutes. Speaking of driverless transit technology being a solved problem, I just absolutely loved this one. Morgantown, West Virginia has had a fully automated version of this for 50 years. It's true, the Morgantown Personal Rapid Transit System is about the same size and network. It's demand responsive. It basically does all the things the Vegas Loop purports to do, but it does all of it with driverless vehicles and went into operation 50 years ago. Once again, what are we doing here? Also, there's a guy in Everett, Washington that dug a 45-foot-long tunnel over a summer with nothing but a spoon. Last time we did the math, it took 13 spoon guys to exceed the tunneling rate of the Boring Company. I don't even want to fact check this one because I'm afraid I'll find out it isn't true and just can't handle that today. I got a few comments from people who didn't feel like I actually gave a full picture of just how dismal the Vegas Loop operation actually is. Must be awful driving in those tunnels. The road is not even smooth by the looks of it. And that is true. I don't know if the video I took does justice to how weirdly uneven the grading is on the tunnel roadbed, but yeah, it's not great. I feel like a roadway construction contractor would never work again if they delivered a product at this level of finish. And then someone decided to add some color to the whole protocol around payment and interacting with the driver. I'd just add, not only do you have to tell the driver which station you're trying to get to, you have to actually hand them your phone with the QR code open on the screen so they can scan it on the reader they have attached to their dash. This is the state of the art in 2025, you guys.
Taste these cheesy jalapeno bites. They're not just starters. They're party starters. Tasties. Feed the fun.
Also, I failed to mention current events. Had a conversation with a driver about whether or not anyone has just walked into the tunnels, and he mentioned that only the week before a few skateboarders were in there, a driver wasn't paying attention and hit 2 of them. This was actually something I heard about while I was down in Vegas and just totally forgot to include. In fact, there have been a ton of trespasses and intrusions into the system, which I guess is bound to happen when your tunnel entrances look like this. Okay, next up, I have to address a bunch of comments from people who just didn't appreciate that I had anything critical to say about The Boring Company at all, so buckle up. While you're here, engage the various screen elements. You know, the dislike button is a pretty solid option, and there's no such thing as bad engagement. Well, actually, there probably is. I'll let you decide for yourself. So one thing about having a video that manages to achieve escape velocity is I just get loads and loads of comments from people who have never been exposed to my first-rate presentation skills. For example, I love the content, but I think you could spend time with some elocution training. You have occasional cases of some mild uptalk and pausing in the middle of sentences and running on at the end of sentences. I think this is all true, but unfortunately, elocution training is not included in YouTube's generous benefits package, so I think you're kind of stuck with me the way I am. Your inflection should be criminal, which I think is actually a mainstream opinion. Impossible to watch beyond 15 seconds with that voice cadence. I can't even argue with this because it's literally in the analytics. Like, over a quarter of people bail on this video in the first 30 seconds. I've made my peace with it though. I mean, what am I gonna do? Feed my script into an AI voice generator and use that for the audio track? I guarantee you no one wants that. Well, almost. I feel like there's major overlap in the Venn diagram of people who don't like my style and people who just don't like what I have to say. The irony of complaining about a company that is going nowhere and takes a long time getting there is that it also describes this video. It seemed to me that the 22-minute video was 8 minutes of promoting things and 16 minutes of very dry talk about a transport service that you don't like. I'm not sure that math checks out, but there was definitely 8 minutes of self-promotion in the video, and I don't apologize for it. Mostly though, my comments are just loaded with Boring Company apologists. I can never figure out why people feel like they have to go on the internet and defend the honor of a billionaire, but that's where we're at. This guy. The objective of the Boring Company is to create a tunnel boring machine that is significantly cheaper to run than any other. Yes, it is exponentially cheaper to drill small diameter holes that don't allow for any sort of useful emergency egress. Some excuses for why the vehicles aren't driverless. Sure, Tesla's self-driving is bad, but have you really looked into Waymo? And some excuses for why the build out of the loop is way behind schedule. This one's even worse. This project was mostly privately funded and could be looked at as a beta/pilot. This is intended to find inefficiencies. I could be wrong, but I don't think this was pitched to Clark County or the city of Las Vegas as a beta test. But if it was, that would be pretty outrageous. To be fair, if the government tried to do this, you'd have maybe 2 stations in twice the time. Curious to see how it looks in another 5 years. I'm hopeful. If the government tried to do this, it would actually have 0 stations because any kind of legitimate alternatives analysis would have revealed how comically stupid this thing is compared to a conventional transit system. This person says Tesla full self-driving is actually good as long as you have all the new equipment and software, which, unlike the previous versions apparently, is awesome and super reliable. The only thing I worry about is keeping my eyes on the road, but not because it's dangerous not to. The nag system in the car will turn off access to full self-driving if you look away from the road too much. And the temptation to look away is constant because I feel so safe. Just your daily reminder that the overall safety of our transportation system is determined by the judgment of the least safety conscious people using it. I don't know you and I'm not familiar with your content, but you seem to be awfully negative about the Vegas loop and interjecting your personal feelings like this is a hit piece geared directly at the CEO of Tesla Inc. I'm not saying your analysis is incorrect, but to me it's obvious that you have some type of personal animus. This person wasn't the only one to leave a comment like this, and it kind of makes me wonder if they watched the video at all. Like, I made a conscious effort not to make it about that guy because I thought it would undercut the points I was trying to make. I suspect most people got it, but it's funny the way people will hear what they want to hear. This is actually the best one. I disagree with your framing, and I hope you're not consciously or unconsciously jumping on an anti-CEO of Tesla Inc. bandwagon, falling into bias, or getting caught in clickbait audience capture trap. Actually, this guy wrote an entire essay. I feel like the common denominator with all of these apologists is they just take themselves way, way too seriously. So, I don't know. My fear is people who are predisposed to think the worst of the Boring Company watched and enjoyed.
About 2 years ago, I did a rundown of what you as a buyer can reasonably expect in a watch at a given price. When is it reasonable to expect a mechanical movement? At what price does a COSC certification become standard? Where do you get most bang for your buck in terms of watch, and when does brand pricing really start to kick in? Well, things have changed a lot in 2 years. Prices have moved, manufacturing quality has gone up, and micro brands aren't just direct to consumer fashion watches anymore. A lot has happened. So I'm taking a look at it all again. What should you be looking for? What can you expect? And what does best in class look like? I'm going to tell you the conclusion up front. The sweet spot is somewhere between $1,500 and $3,000, maybe $4,000. Tudor is no longer the value leader. The rest of the video is about taking you through the steps that get me to that conclusion. We're talking about what goes into manufacturing, the price of parts, all that kind of stuff. Let's dive in. We start with the basics. What makes up the core production cost of the watch? Designing a watch. Taking the time to draw a design, turn it into a 3D model, build a prototype, refining the design multiple times is both a creative and technical process that takes time and money. If you're just copying somebody else's design, that cost goes down. If you're starting from scratch, it's going to take more time. And if the community has deemed that you are good at this, like a recipe, then you get to charge a lot for your designs because that's what you're good at. But even for those people that are untalented and unknown, there is a cost associated with it. Materials: steel, titanium, gold, tantalum, platinum. Materials cost money in a couple of ways. There's a base cost of the material, but the material also has a cost profile to work with. Platinum is rough on tools, and that wear and tear is priced into the material. Then there's the big bucket of manufacturing. Somebody somewhere has to buy a couple of machines. Those machines cost money. And I did a quick, lazy Google, and I could find a CNC machine that only does engraving. Depending on the model I wanted, it cost me between $9,000 and $15,000 for one. You need a lot of machines to mill, to cut, to polish, to engrave. You need tools for those machines. You need electricity, lubricants. The reality is a lot of new brands won't have the cash to buy all of those machines. It would be way too expensive because you need a certain volume in sales to recoup the investment of all those machines, all those $15,000, $20,000, $30,000, $40,000 machines. Every single one you have to earn your money back on. So instead, a lot of companies reach to other factories that specialize. Those companies also have to recoup their cost for all those machines, but on their side, they have the volume that small brands don't have because they can do stuff for multiple brands. And also, side note, CNC machining is not just a question of starting up the machine. Not everything is CNC machining, but CNC machining is not just about starting up the machine. There's technique and experience involved, knowing which settings to apply, making the most optimal routes. All that kind of stuff is not something you just do. You also need people to do some things manually, like assembling large parts of the watch, but also to attend to those machines, to repair them, to check the quality. It's not a massively people-intensive industry, but you do need people. And that's what goes into the base cost of the watch. The important thing on YouTube is subscribers, and people subscribe when they enjoy the content. So if you're new here and you've made it this far, you might just be enjoying the content. If so, click the subscribe button and be notified when I put out new videos. Thanks. On top of all those base costs, you've got marketing and other costs like the HR department. If you don't market, nobody will know about your watch. If nobody knows about it, it won't sell. You can hope for word of mouth. But if you're a Swatch Group who has 33,000 employees, building a new watch and hoping that somebody will notice it in the store without you advertising that it exists is a pretty risky approach. So marketing and branding is not just a waste. It's a balance and it's a risk, because if you spend nothing, you sell nothing. If you spend a lot, then you eat into the profits of the pure watch price. Distribution also has a cost. The main distribution approaches are either direct to consumer or through some sort of reseller. So ADs. ADs have employees too. They also have stores and leases and electricity costs. So they have to make a profit as well. So if you go down that route, your watch is going to be more expensive for the end consumer than on a direct-to-consumer model, because there are more people in the chain that need to make money. This is important because some people will compare a Tudor to a Christopher Ward, and some people will feel that there's a relatively large price difference and not as large a quality difference. And that's not just because Tudor or some other brand just wants to charge more. It's also because those Tudor boutiques and AD stores need to make a profit too. It's not all of the cost difference, but it is part of it. Your access as a customer to a boutique where you can try the watch out and talk to a salesperson and go down to in person when there's something wrong is a convenience for you that has a cost. Finally, taxes, tariffs, and all the rest at a cost. Those Chinese watches you can buy online for $250, well, in the US, they were exempt from taxes and tariffs because there was an exception in the law called the de minimis exemption for products under $800. Not anymore. As of April 2nd, those products are suddenly more expensive because the tariff is there. And now here's a slightly exaggerated but not incorrect thing to keep in mind. You can't buy all the parts for one watch, sell it, and make a profit. If you're doing everything yourself, that first watch is not covering the costs of your factory, your wages, and all the machines you bought. If you're calling some factories who are doing some of those things for you, they're also not going to spin up a CNC machine to make one watch. They're going to expect you to commit to a minimum volume. So up front, you're locked into the cost of 50 or 100 or 1,000 or 10,000 watches before you've even sold one. Every time you introduce a new watch, you're locking in a ton of cost and crossing your fingers that you'll move all your stock, because there's no profit in the first or second or third or 10th watch. And there's no guarantee you'll sell everything that you've committed to producing. On top of that, if you make your website and you do a little bit of advertising, that cost is an upfront cost. You haven't sold anything yet, and you're already hundreds of thousands of dollars in the hole in costs. You only have a pile of unsold watches and bills to pay. So how do you price the thing? So I've got my model, 5 components: manufacturing the movement, craft, design, branding. I'm not going to explain them. I've done it a million times. Don't skip ahead. Not going to go into more detail about that. What is important though is each factor contributes to cost, but it also affects the range for pricing in different ways. Simply put, some things cost more to do because they're harder to do, but not all things that you do that are harder to do allow you to charge a whole lot more, because customers value different things differently. An example: a sunroof in a car is something people are willing to pay more for, and it's a feature that customers see as a premium luxury. So car makers can mark up that as an add-on much more than a lot of other things. But air conditioning, it's not really a premium luxury feature. You can charge an add-on for it, but there's a limit to what people think is reasonable. Don't you agree? So for the manufacturing of the movement and the externals, a milled clasp versus a stamped clasp is going to be more expensive to manufacture. But I'd argue that most people don't see a milled clasp as a premium feature anymore. It's a feature that's expected for a good watch. Pin and collar versus screwed links. It's not really a premium feature, even though one is probably better than the other. What about titanium? I think people have been convinced that it has a premium label on it that potentially allows for a higher price. Gold, definitely. Saratsu polishing, maybe. One of the things I do when I'm down at an AD is I listen to what the sales rep says, and I listen for those talking points, because they'll tend to emphasize the elements that are building the argument for the higher price. Same thing goes for movements. Blued screws, anglage, Côte de Genève, display case back, custom rotor. COSC, I don't think allows for a big premium price bump. COSC certification, you basically take the same base movement, but it costs more to regulate it more stringently. Then you have to pay to get it certified, and you have to factor in the failure rate of movements that don't pass the certification. That adds cost. But I don't think it's a premium feature. METAS might be a premium feature, but METAS is even more stringent, so you have to factor in that not all your watches are going to pass the test. That's a cost. A pretty movement does allow you to premiumize the price. A couple of gold components definitely allow you to premiumize more. There are tons of these things. If you want a ceramic bracelet and you want it polished, you can do it the cheap way or you can do it the expensive way. You throw the components into a tumbler and you'll get a really good polish. You'll also polish a lot of the components at once, which lowers the cost, but you do compromise because you get a rounded edge because the polishing process will round the edges. If you want high polished ceramics with sharp bezels and varying polishing techniques, then you can't do it with a tumbler. You need to go through a CNC machine or some other process that possibly involves human hands, and that's slower and that's more expensive. Hand polishing, it adds massive cost, but at some points people don't understand the value of it. I think Rolex is a brilliant example of this mechanism in play. If you look at a Rolex, one thing that really drives up both the production cost but also the ability to premiumize is that despite the watches being mass produced, they don't really skimp on the details. So you've got a bicolor ceramic bezel, which is finicky and difficult to do. You've got a laser etched rehaut. You've got tons of detail. You've got marker sharpness. You've got Rolex etching on the crystal. You've got white gold plots. All of these details individually cost something, but how much of them individually allow for a price premium? One of the ways Rolex gets to charge the premium is because they do a lot of these things. They don't just do one thing. They do not skimp. But in general, can the one individual thing justify a price premium? Probably not. Why? Another example. Zenith has their triple calendar Chronomaster that costs $14,000. Recently, they released a limited edition model with a lapis lazuli stone dial for almost $21,000. That's $7,000 more for a stone dial. Do you think a fairly cheap stone like lapis lazuli adds $7,000 or even a proportionate level of cost to the manufacturing? No. I even asked 2 different specialists in dial making.
You serious?
And they both fell off the chair when I told them about the Zenith. They cracked up laughing and said, what, 8K extra for a stone dial? That's premiumization. That's something where they're trying to convince people that this is worth so much more than the actual production cost. Generally, you can't tack on a lot of surplus profit to most manufacturing because people don't understand the difference and don't always appreciate the difference. Especially in the last 2 years, base manufacturing has become so relatively good that features have become so commonplace that it's harder and harder to justify a premium for a lot of these components and manufacturing related features. Having said that, Rolex again is a good example of how they're pushing the envelope on production to justify those premiums. The Land Dweller has a 5 Hz movement with superlative chronometer accuracy. The chicken wire dial utilizes a new and complex technique. The display case back is new for them. The new bracelet involves a significant amount of cost. All of those things are there to justify the Rolex premium. So it's kind of a circular thing. Premium features allow you to charge a premium price, but when you have a premium positioning, it forces you to develop your premium offerings to continue to justify your premium price. Design also has a price, but probably even more than those base manufacturing elements, it's undervalued at most price points. Design is only valuable when the designer allows for a bigger premium. It's only when you get to the high end and name brands like Jean and Gruppelforce and Crivia and I don't know how to say his name, start getting mentioned that people really are willing to pay. There are a couple of small ones, Kudoke can get away with it, others as well, but generally a sub 5K brand is not going to be able to charge extra for design. A few do succeed, but generally it's really dependent on the Genta name or the George Smith name or whoever. That's how elusive and rare the premium is for design because it's so attached to the designer. Handmade costs money. And if they work in the East West, it's even more expensive. Hand engraving, detailing, hand setting, every single time you have a human do something in the process, it slows things down and drives up the cost. It's slow, it reduces output, it's not ideal for mass production, so it's used sparingly. So it adds huge cost, but generally, this is one of the things that also allows you to have a broader range for pricing. Why? Because people intuitively understand that handmade is slow and meticulous. It signals care and skill and attention to detail that people are willing to pay extra for. Algotrading is a really good example. Considering the movements inside their watches and their fairly basic case designs, their watches are at a first glance a bit more expensive than others. But then you think about how slow and finicky hand painting and enameling and that kind of thing is. Algotrading doesn't tack on the premiumization bonus as much as Glashütte and Blancpain and Algotrading do, but they probably could because people know it costs extra to take the time to do those kind of techniques. Finally, identity. A no-name brand can make the best watch on the planet, but without the brand name, they could likely not charge at a Patek or Rolex price point. It's as simple as that. High-end Chinese watches are getting really good. They are typically cheaper than comparable Western high-end watches. And that's in part because they're cheaper to make, absolutely. But it's also because there are less people that are willing to pay a Moser price or a Richard Mille price for the Chinese version. The Chinese version does not have the identity for most people that commands a premium. For me, I think identity and brand is what you, in military terms, would call a force multiplier. It's the X factor, and when applied appropriately, it allows you to charge a premium. Does it cost you money to establish that multiplier? And the multiplier can't stand without design and manufacturing and craft that aligns with customers' expectations. But when the expectations are met, you can multiply. So basically, you've got good manufacturing, good movement, simple design, and limited craft, then that's going to be your base value. And if you put Monta on the dial, you could charge a little bit more. If you put Tudor on the dial, you could probably charge even more for the exact same watch. And if you put Rolex on the dial, you can charge even more. But as I said earlier, when it says Rolex on the dial, you can't skimp. You have to have those etched rehotes and the white gold plots and no stamping anywhere. It just has to be, people are going to be looking for the faults to a much higher degree than if it were the exact same watch and it said Monta on the dial. For me, thinking about all these things has made it so much easier to define or sort of identify the sweet spots for different elements of watches. So for movements, under $500, you should be expecting an NH35 or similar movement. It could be quartz, but if it's a mechanical watch, it's going to be an NH35 or a Seagull ST1001 or something similar, maybe a Miyota. Power reserve right now is going to be around 40 hours of power reserve, and you're not getting much better in terms of accuracy guarantees than minus 20 to plus 40 seconds. Sometimes they will perform better than that, but importantly, brands don't guarantee better.
There's magic in the arrows. This is the biggest challenge we've ever done. Tonight, we complete that challenge. For one last time.
If you move up to $1,000, you can expect a Sellita SW200 or something similar. Powermatic, for example, you're still mostly around 40 hours. You're starting to see basic display cases and simple, not particularly elaborate custom rotors accuracy improves and you're getting, minus 12, plus 30, maybe some minus 12, plus 20. As you go up in the grades of the movements, accuracy improves, finishing improves, anti-magnetism improves, reliability improves. ETA have their comparable offerings in the Powermatic 80 at this price point. You get more power reserve, but you also get more synthetic components in the cheapest grade of the watch. There's a bit of a compromise. More power reserve, less sturdy movement, on balance. COSC certifications start to kick in around $1,500 and above, give or take. Power reserve starts to increase as well. Anti-magnetism, all those kind of COSC type features start to get really strong in watches above $1,500. Then you get to $5,000 for a Tudor with a full META certification, -4, +6, I think it is. 15,000 gals tested in the case. IWC has their 120-hour movement at $6,000. At $13,000 for Rolex, you still get a Metis comparable superlative chronometer with about 100 hours of power reserve, 5 hertz, of course. But the point is, the pure movement reliability, accuracy, power reserve, quality assurance doesn't really get much better over $3,000-4,000. From the Tudor Metas movement to the Rolex, the price is a $6,000 price difference. On paper, the difference in the movements is relatively small. The Kinesi is not a good-looking movement, but just in terms of pure, sort of quality of what it can do, the difference between them is not that huge. There are differences, and I do stand by also an Omega being better. They're more reliable. They're also much prettier than the Kinesi movements. The Rolexes are also more solid than a Tudor, but I can't in any way argue for there being a $6,000 improvement on the movements. So for movements, the best value for money in terms of what is around and in terms of price to performance ratio is somewhere between $1,500 and $5,000, somewhere in that range. Manufacturing. If you put a blindfold on and were asked to handle a Rolex and a Tudor and an Omega, so $10,000, $6,500, and $5,000 for a diver, would you be able to tell the quality difference of the bracelet, case, or crystal? My guess is most people wouldn't. I mean, you guys would because you're insane and you'd just touch it like, oh, that's the helium escape valve, that's the Seamaster, and you would touch over here and you say, oh, that's an oyster bracelet. But normal people that have lives would not be able to tell the difference. Nerds, sure, but regular people, they wouldn't. And what about Tudor, a Formex Reef, and some Chinese factory brand? Blindfolded. It's going to be hard, and I admit it, it's going to be difficult. Give me time, and I will find a difference, but on a lot of things, it's really hard. Unblindfolded, it's a little bit easier, but a Rolex versus an Omega is still not an easy comparison. Getting into the details of a Rolex, there are going to be so many micro details that add cost, but how many % more precise is the bezel action of a Rolex than on a Tudor? And how much of that is down to quality and just down to how the brand wants the bezel action to feel? I've handled a Girard-Perregaux ceramic Laureato, a Zenith Defy ceramic, and a Formex Ceramica. There's not a lot in it, if anything. And there's $15,000 between the cheapest and most expensive watch. Now, there's movement differences, but I'm just talking about sort of, if you look at the things in isolation, there are differences for sure, but it's really close. But you still get brands below $2,000 that offer a stamped clasp. You still get sub $1,000 watches with jangly bracelets with pins and collars. Micro Adjust isn't consistently available below $2,000. Some brands are going to have it, but they might cut corners somewhere else. And on the other end of the scale, above $4,000, $5,000, tell me what you consistently get more of that is noticeably and markedly better. Can you tell that a $10,000 Reverso is better manufactured than a Tudor? I mean, it's a hard comparison, but it's really difficult to tell for a normal person at least. The sweet spot right now where the price and performance are optimally balanced is somewhere between 2 and 4K for those kind of manufacturing things. The point is, on the manufacturing, it kicks in a little bit later than movements, but it balances out a little bit earlier. Craft. Atelier Wen offers a hand-turned Guilloche dial at $3,000. Formex offers not a handmade, but a technically impressive gold Meteor dial at $2,500. The CW12 at $5,000 has hand-polished and faceted beveling on the case and also, I think, the balance bridge. Those examples are actually few and far between. There's no hand-engraved swan neck regulator on a watch under $2,000. At least, I mean, there might be one, but it's not consistent at all, and it's incredibly rare. It's not even consistently available all the way up to Rolex pricing, and that should tell you something. An Omega Metas movement is good looking, but the detailing is, to my knowledge, entirely done by machine. And Ordain, they do manual or hand enameling at $3,000-$4,000. The biggest, most impressive feature of the new Breitling B31 movements is the level of anglage, Côte de Genève, and engraving that has gone into that movement. A lot of that is machined, so it's not quite craft, but that's a part of the reason why Breitling believe they can charge $6,200 for a new Super Ocean Heritage. The reality is, craft is relatively uncommon below even $10,000. If it's in there, it's sparing and focused on one or two things. It's a dial or hands or a single engraving and a spiff-duff movement. It's not like a highly complicated Lange where every single component has passed through the hands of a professional. But there is a sweet spot where you get a lot of craft for your money. And it starts around the Glashütte Original level of $10,000, $13,000, and it stops at the lower end of Lange and Söhne, so $20,000, $25,000. That's where I do believe you're getting the most craft for the least amount of money. Above that price point, it's an entirely different game. When you go above 25,000, you really have diminishing returns. I think a Gröbel Force handmade for $1 million is probably entirely justified, but the sweet spot is from Glashütte to low-end Lange with a dip below for, I'd say, one brand only, Grand Seiko. With them on craft and sort of the Venn diagram overlapping to manufacturing, Grand Seiko do outperform more or less any Western brand. Two more things to go. Design. Design is everywhere. There's the unmentionable color brand, which I believe has strong designs for $600. Tissot also makes nice watches at $600 to $1,200 and above. But I would argue that below a certain point, brands do not tend to be as consistent. Orient, Citizen, Seiko, Hamilton also have some real dogs in their lineup. The lower end price you get, the more you are in the volume and options game as a manufacturer with consumers. And that does tend to lead to bigger product catalogs with less consistent designs and design languages. I think the cutoff point is around $1,000. Above $1,000, you do start to get more consistent in design quality. The designs might not be to your taste, but there's just more consistency and coherence in product catalogs. This stays the case all the way up to the most expensive watches. You could make a case, I think, that below 4K, there are more brands that are a little bit more derivative and inspired by others, and that is, I think, likely to some extent true. From $1,000 to $4,000, you're still competing for customers who want a nice black dial diver or a nice blue dial sports watch or a nice waffle dial integrated bracelet watch. So in this space, brands do tend to sort of aesthetically converge a little bit. The counter argument, though, is that these brands are often only seen as derivative because there are more new brands in this space and brands with less heritage and less storytelling attached to them. The fact is, even a Submariner is ultimately derivative of something else.
With Gemini and Gmail, Jenny can summarize all 37 PTA emails and quickly...
Where does the price or force multiplier for identity kick in? I'm going to throw out a hard number and say $3,000. Above the higher end of Longines types watches, brands start to command a premium. And if you asked me 2 years ago, I was convinced it was Tudor where you were getting more watch than brand, but I don't think it's the case anymore. Tudor's a phenomenal brand, they still are. They make great watches, but they're not the value choice anymore. There's, these days, a definite premium there. I also think they know they're still popular. So over 3K or so, identity really starts to pump the price. And this is an opinion, but I'd like to state it almost as a fact. Longines, Formex, Christopher Ward, and Ordain, great watches, but they're not so good that they can command a huge premium for their name. Rolex is so far outside of the sweet spot that it's almost ridiculous. Omega is also charging a premium for their name. And I repeat, these brands' watches are better for sure on almost every single parameter, and that does make them more expensive to make. But they are not $6,000 better than a comparable Tudor. They are not $8,000 better than a comparable Longines. So from $0 to $1,500, you will get less than stellar movements. You can get absolutely excellent manufacturing, but it's not a consistent characteristic of the price range. Sometimes it is, but not consistently so. Design can be good, but it's also potentially not consistently good. There's no craft of any type to speak of, and you pay next to nothing for identity. You also pay no premium for distribution and fancy stores. Above $3,000, but it's not but sure on almost $6,000 better than a comparable Tudor. They are not $8,000 better than a comparable Longines. So from $0 to $1,500, you will get less than stellar movements. You can get absolutely excellent manufacturing, but it's not a consistent characteristic of the price range. Sometimes it is, but not consistently so. Design can be good, but it's also potentially not consistently good. There's no craft of any type to speak of, and you pay next to nothing for identity. You also pay no premium for distribution and fancy stores. Above $3,000, you more or less consistently get really good movements. But there are a few exceptions. You get excellent manufacturing with tons of micro detailing. You get cork sniffing worthy details to the manufactured product that raise them above $1,000 or $3,000 watches. But you do need to really pay attention to notice. You still don't get consistent craft. That only kicks in at $12,000 to $13,000 and above. When you do see it, it's rare and focused to a few things of the watch. And then there's $1,500 to $3,000. Cost movements, good power reserves, consistent premium manufacturing with modern day features, quick releases, easy adjusts, aligned bezels, crisp details, precise plots, hands. You get an investment in consistent design. You get a lot of direct-to-consumer brands that can offer a competitive price because they're not sharing profits with a retailer that also wants a cut. And none of these brands really have a name that commands a massive premium yet. Even sometimes not being a premium brand is part of their value proposition. So if I were today, in 2025, to give an answer to the question, where can I get a really good value watch with all the modern features that could potentially last me a lifetime for a competitive price, I would say somewhere between $1,500 and $3,000-ish. Maybe $4,000, not higher. And who's in this space? Formex, Christopher Ward, Longines, Anodain, Zinn, Hanhart, Nomos, Atelier Wen, Louis Erard, sometimes Frédéric Constant. Above this point, you get fabulous watches from Tudor and Omega and Glashütte, but you're on the steep end of the curve of diminishing returns. $1,500 to $3,000, $4,000-ish. That's where the sweet spot is at. Now, outside of this price range, I think there are a couple of brands where you get, let's call it, more than the rest at similar prices. Grand Seiko is still to this day priced really well for the overall feature and quality set from end to end. Glashütte Original as well. They are expensive, but they have elements of craft and attentions to detail that makes them really compelling, especially compared to, cousins over at Swatch Group like Blancpain. Breitling has never been cheap, or maybe they were one sometime, but they haven't been for a long time. But with the new B31 movements, I don't think they're value for money, but their offering has definitely improved compared to what it has been for a lot of years. Under $1,000, a couple of Chinese brands do punch above their weight. They're not perfect, but they have strengths. I doubt they make much money on their consumer offerings. Their profit comes from producing for other brands, and the consumer offerings, as far as I can tell, are just there to stick it a little bit to the Swiss brands and function as a showcase for people who want to have things manufactured by them. Their movements are generally forgettable. Their designs are, blatantly derivative at best. But credit where credit is due. They are usually pretty solid. A lot of Chinese brands are crap, but there are a couple in between that are really, really strong. High-end, Moser, relatively reasonable, all things considered. IWC, also offering a lot these days. $6,000 for a IWC Pilot Mark 20 is the same as an Aquaterra, is the same as a Breitling Top Tying, is a little bit less than a Oyster Perpetual. Not an Oyster Perpetual, yes, an Oyster Perpetual. You're paying for the brand name, but overall you get a strong package. If you want to know where I think performance and price is out of sync, Panerai still has too many shortcuts. Jaeger LeCoultre still off balance in terms of pricing relative to quality. Their more unique offerings are really compelling, but the core catalog to me feels out of sync. Blancpain completely off sync, Bremont off sync, Seiko out of sync in their cheapest offerings. When you get to the SPPs and the SJE models, it's fine, but a lot of their sub 1K offerings are just quality-wise not competitive. That's where I think we are right now. I hope you leave having a better idea of what to expect and what to look for. Share your thoughts in the comments. Expand on my thinking and add your perspectives. That's why we're here. Elaborate in the comments below. Like I said, like, subscribe. Cheers.
Yesterday.
Have it.
How's everyone?
Well, hello, everyone. Thank you.
Hello. In turn order, left to right, we draft. And so
I'm in India still. I will also take the inquire action. So I'll put one here. I'll draw all four. No, you look at these on stream, and I'm taking, this one. And that becomes immediately played face up. So I will
now I
actually
want to
do a better look at
yeah,
these.
while
just so
Drew
that folks
does
can
that,
see
I just
this.
want to point out differences here. So Drew's action is a persistent. So it's taking up one of his action slots. He's got a plantation. His opium cannot be undersold. Drew, what is happening on your?
Sorry,
There you go.
I'm showing off the India pile to my streamers, not you.
This
Okay.
video is
Okay,
sponsored by The
sorry.
Daily Upside. More on them later in the video.
They probably have as high an average IQ as any 16 people working together in one business in the country. The whole story is really fascinating. If I ever write a book, it's going to be called Why Smart People Do Dumb Things.
In the mid-1990s, the Wall Street equivalent of an NBA All-Star team was assembled to launch a hedge fund.
Hello Civ fans, Sean Wilson here, QA lead at Firaxis. I'm back once again to walk you through the latest changes and improvements to Civilization 7. As we noted on our last update, the team is continuing to develop major features behind the scenes, like the ability to play as one Civ through all the ages, along with substantial updates to legacy paths and victories. Because of that, I want to acknowledge up front that the update for 1.3.1 is going to be a little bit smaller than our past updates, but there's still plenty to enjoy. You'll find balance tweaks, a new map type, and improvements to biomes, along with some other changes coming with the full patch notes. Let's dive into the details. Our first priority for 1.3.1 was to continue our strategic balance pass efforts that we kicked off last month on individual civs. You'll find a healthy mix of nerfs and buffs to the following civs, including Egypt, Rome, America, Buganda, Russia, and Mughal. We'll highlight a few key changes here, but there will be even more details in the full patch notes. We've heard your feedback that 1.3.0 made Egypt a little too powerful. Our bad. So this month, we'll focus our efforts on bringing Egypt back in line with our original intent, reducing effects like yields on minor rivers. For Rome, we've reworked
Nobel winners Myron Scholes and Robert Merton, and 3 of the brightest mathematical minds in the world.
They used an undisclosed trading strategy to... This video is sponsored by The Daily Upside. More on them later in the video.
They probably have as high an average IQ as any 16 people working together in one business in the country. The whole story is really fascinating. If I ever write a book, it's going to be called Why Smart People Do Dumb Things.
In the mid-1990s, the Wall Street equivalent of an NBA All-Star team was assembled to launch a hedge fund.
Future Nobel winners Myron Scholes and Robert Merton, and 3 of the brightest mathematical minds in the world.
They used an undisclosed trading strategy to deliver staggering profits for its clients over a 4-year period. But in the 5th year, the fund entered a death spiral. Losses so violent that they threatened to take down the entire financial system.
Had the failure of LTCM triggered the seizing up of markets, substantial damage could have been inflicted on many market participants and could have potentially impaired the economies of many nations, including our own.
This insane 5-year roller coaster began in 1994. A hedge fund called Long-Term Capital Management begins trading money for its clients. Among them are wealthy individuals, institutions, and even foreign governments. And collectively, they hand over more than $1 billion to the firm. Only the insiders of the fund know the exact trading methods they'll use to grow that money. But that didn't matter to the clients because the results were speaking for themselves. In May of that year alone, they generated a 7% profit, and by year end, a return of 28% before fees. A year, by the way, in which the stock market broadly was down. The market bounced back with a 34% gain the following year, but it had nothing on long-term capital management, a 59% gain, and had now grown $1.25 billion of starting capital into $3.6 billion in just 2 years. Year 3 was an equally impressive 57% return, followed by 25% in 1997.
Your game doesn't play the way it should? Perfect. Hobbies don't need to chase perfection.
In October, 2 of the hedge fund's partners, Robert Merton and Myron Scholes, were awarded the Nobel Prize in Economic Sciences for developing one of the most important formulas in financial markets. The Black-Scholes model, a way to determine the value of derivative securities such as options or futures contracts. The incredible irony is that it was a misapplication of derivatives prices that made 1997 the last profitable year for the fund. Within 6 months, long-term capital management imploded, dropping 6.7% in May, another 10% in June, and it just got worse and worse. On August 21st alone, they lost $500 million, and by the end of that month, they'd set fire to nearly all of the $5 billion they were managing for clients. The New York Fed president needs to be briefed on the situation, and what he sees behind the curtains is horrific. The remaining $2.3 billion of clients' money was leveraged at a ratio of 55 to 1. The hedge fund was about to default on more than $100 billion of debt. Money that had been lent out to more than 50 financial institutions, and with some of the loosest loan terms he'd ever seen. This wasn't going to be an isolated collapse. It had the potential to cause a domino of defaults and losses all across Wall Street. This might be the craziest story I've come across, and I'm going to show you the inner workings of this hedge fund. From the specific trading strategies they used, the disastrous mistakes they made, and the negligence of Wall Street who poured gasoline on the long-term capital management fire. Many of the baffling details of this story come from Roger Lowenstein's book, When Genius Failed, so all credit to him and his incredible journalism. Before we continue, I just want to pause the video and share with you an incredible free resource for staying up to date with the business world. The sponsor of today's video, The Daily Upside. They're a completely free daily newsletter with over 1 million investors subscribed, including myself. It's really easy to sign up, and with just 5 minutes each morning, you'll be able to get up to speed with the top finance and investing news, including insights, analysis, and clarity on the top business stories circling the globe. I've been a long time and avid reader of the Daily Upside, not only because it helps me to stay up to date, but because their stories always include unique details that I just don't find in traditional media, such as this fascinating analysis of consumer spending they shared in one of last week's publications. Again, it's completely free to sign up, and you get one information-filled email each morning. Join over 1 million people who trust the Daily Upside and sign up using the link in the description. Okay, so right at the center of this story is John Merriweather, the founder of Long-Term Capital Management. He's the man who was able to bring so many prominent figures from finance and academia together to manage money. And their main trading strategy was discovered by Merriweather in 1979, kind of by accident. He was a trader at Solomon Brothers, running a fixed income arbitrage group that he'd started 2 years earlier. One day in the middle of June, he received a phone call from John Eckstein, another trader from outside the firm. He told Merriweather that he was on the brink of bankruptcy, all because he was stuck in a treasury bond arbitrage trade. Eckstein needed Merriweather to buy him out of his bet, but this was no small ask. This would mean convincing the Solomon Brothers executives to allocate tens of millions of dollars to a single trade, a sizable percentage of the firm's $200 million of capital. Merriweather explained the trade to his bosses. It would involve buying US Treasury bills and at the same time short selling the futures contracts of Treasury bills. The profit opportunity was the tiny difference in price between the futures and the actual bonds. Effectively, the trade would make money if the two prices converged. Hence, it's called a convergence arbitrage. Surprisingly, the Solomon leaders gave him the all clear, although the managing partner set a contingency. If the trade didn't work, you'll be fired, he told Merriweather. This was a light bulb moment for Merriweather. That convergence arbitrage strategy would become the exact blueprint for his own hedge fund, Long-Term Capital Management. And luckily, the trade worked, so he wasn't fired. Or, more accurately, he wasn't fired that year. He was actually fired in 1991. Another Solomon trader, Paul Moser, confessed to Merriweather that he had illegally rigged a US Treasury auction by submitting fake bids. This is obviously a crime, but it wasn't reported to law enforcement. The Solomon executives decided to handle it internally. This was based partially on the recommendation of Merriweather, who believed it was a one-time mistake. It turned out that Moser had in fact violated Treasury auction laws repeatedly, and in August 1991, it was exposed. Moser went to prison, and Solomon was fined $190 million. The CEO resigned and was temporarily replaced by Warren Buffett, who had recently acquired a 12% stake in the firm. Shortly thereafter, Merriweather was forced to resign, a decision that fostered resentment of Buffett among the Solomon traders. Although, as it pertains to this story of long-term capital, Warren would ultimately have the last laugh. Starting this video with the words of Warren Buffett was no accident. The man unanimously known as the greatest investor of all time appears repeatedly throughout this story. Out of a job, Merriweather looks to start his very own hedge fund, and in 1993, he began assembling what could only be described as the dream team of Wall Street. It starts with a number of ex-Solomon traders: Eric Rosenfeld, Victor Haghani, Greg Hawkins, and Larry Hillebrands, among others. He then sought to recruit the very best from academia, starting with Robert C. Merton, a legendary figure in the finance world because of his research on one of the most important unsolved problems in markets: how to correctly price a stock option contract. The problem was already being tackled by two other genius economists, Fisher Black and Myron Scholes. They'd mostly cracked it, but Merton arrived on scene in the 70s and completed the formula. Black and Scholes published their findings first, and so it was named the Black-Scholes model. If you've been to business school, then you know just how big of a discovery this was for the investment banking world. It's like Einstein's E equals mc squared, but for investment risk. Scholes and Merton would both win the 1997 Nobel Prize in economics for it. But back in '93, they joined Long-Term Capital Management as partners and on the board of directors. And a few months later, they'd recruit David W. Mullins, former vice chairman of the US Federal Reserve, the second highest position at the Fed. What's important about this all-star lineup was the level of prestige it gave them. It was really great for getting early investment, but it also led many banks to overestimate their abilities, something that would create huge problems in the future. Merriweather approached Merrill Lynch, an investment bank who would help raise the initial capital for the fund. Merriweather's goal was to raise $2.5 billion, way more than the 25 to 50 million that is typical for a hedge fund launch. Acting as the placement agent, Merrill Lynch hosted a global fundraising roadshow in late 1993. The pitch to prospective clients was that long-term capital could exploit relative value opportunities in the bond market. The partners would charge a 2% fee on assets as well as 25% of profits, a lot higher than the typical structure of a 1% fee and 20% of profits. Clients would also have to have their money locked in for 3 years, another atypical feature for a fund. But this certainly didn't diminish the huge amount of interest for people wanting to have their money managed by such an all-star lineup. Investment poured into the fund from wealthy individuals, and a few institutions put up over $100 million each. Sumitomo Bank in Japan, Dresdner Bank in Germany, Julius Baer in Switzerland, and even the investment agency of the Italian Treasury. Not everyone was convinced. Merriweather traveled to Omaha for a dinner with Warren Buffett. He swiftly declined to invest. All up, they'd raised about $1.25 billion. The partners themselves put $146 million of their own money into the fund, and by 1994, they were ready to begin trading. In February, Fed Chair Alan Greenspan raised interest rates for the first time in 5 years. It triggered a global bond sell-off, and long-term capital noticed something unusual about the yields on the 30-year Treasury bond. In August, a brand new 30-year bond had a yield of 7.24%, but the exact same bond that was issued 6 months earlier was at 7.36%. The yield and price of a bond are an inverse relationship, so the slightly older 30-year bond was cheaper than the new one. It wasn't cheaper because it was a riskier investment, it was cheaper because of liquidity. The higher amount of buying and selling activity in the newer bond made its price higher. Theoretically, both would eventually become the same price. Long-term capital was able to profit from the prices converging by taking both sides of the trade. They take $1 billion of their equity, the client's money, and they buy the older, cheaper 30-year bond. They then turn to an investment bank like Salomon Brothers and they say, hey, I want to borrow $1 billion of the new 30-year bond. Long-term capital sells the bond immediately, and the cash they receive from the sale is posted as collateral against the borrowed bonds. This is called a reverse repossession, or repo agreement. Let's say it takes 1 year for the prices to converge. At that point, long-term capital sells the old bond, they buy the new bond and return it to Salomon, and the profit they've made on a 0.12% yield conversion is about 1.2%. If that sounds like a whole lot of work for a pretty pathetic return, well, it is. which is why long-term capital did things slightly differently.
The body scanner reveals the brutal truth about your body that your regular scale will never tell you. For weeks, my scale showed...
Instead of using their $1 billion of equity to buy the bonds, they put it in a money market account that earns 5.5%. They still do a reverse repo agreement with Solomon, but this time for $25 billion worth of bonds. And on the other side, they turn to JP Morgan. They borrow $25 billion, buy the old 30-year bond, and post the bond as collateral. That's a repo agreement. Literally just the opposite side of the trade that they have with Solomon. Now the fund is leveraged 25 to 1. So when the bond yields converge and they unwind the repo agreements, instead of making 1.2%, they make 30%. And they didn't use any of their own capital in the trade. It sat in a money market account and earned another 5.5%, a total return of 35.5%. But leverage works both ways. If the yield spreads between their bets widened, the losses would be huge. So it was critical that Merriweather and the long-term capital team could accurately calculate the risks of their trades. This was the role of Merton and Scholes. In early 1995, they wrote a letter to clients with explicit calculations of the probability of various loss scenarios. They claimed that there was about a 10% chance of losing 10% of their money in any given year, and about a 2% chance of losing more than 20%. In other words, they thought it would take a once-in-50-year market event to cause big losses. That year, long-term capital continued with their convergence trades, making $600 million on a single trade of Italian government bonds and a 59% return for the year. 1996 was a 57% return. The fund had turned about $2 billion into nearly $6 billion in just 3 years. However, in 1997, the hedge fund's 4th year, they would make the first in a series of critical mistakes. By now, almost every investment bank on Wall Street was taking part in the bond arbitrage strategies that long-term capital had been relying on. Bond spreads had narrowed, and the profit opportunity just wasn't there anymore. So under the advice of Victor Haghani, the fund turned to the stock market. Haghani believed that the same type of convergence trade could be done with pairs of stocks. Volkswagen, for example, had 2 different types of shares, an ordinary share and a preference share that came with superior voting rights. The voting shares had a price 40% higher than the ordinary shares, so a trade could be set up to profit if that gap got smaller. This was a significant deviation from what the fund was doing in the bond market. Different issues of the exact same 30-year bond should theoretically be the same price, but in the case of Volkswagen stock, the voting shares are legitimately worth more than the ordinary, so there should be a gap in price, and to make matters worse, that gap is purely subjective. There isn't a formula to tell you how much in dollars a vote is worth. Haghani was effectively arguing that the 40% gap was so high that it must be excessive. But clearly these types of trades come with much more uncertainty, so surely they would only place small bets, right? Well, as Robert Lowenstein put it, like a man who pays for dinner with $100 bills and never asks for change, long-term capital management had lost the habit of moderation. The fund made about 15 of these paired share trades, and some of them were absurdly big bets. One bet was on the convergence of the share prices of Royal Dutch Petroleum and Shell Transportation of England. The trade was an eye-watering $2.3 billion. Just like the 30-year bond bets, they used leverage, but the Federal Reserve actually limits the amount of money that a hedge fund can borrow against stocks. So instead of actually buying shares in Shell, they'd go to an investment bank like Merrill Lynch. Merrill Lynch would buy the shares for them and write a contract called a return swap. This contract simply says that Merrill Lynch will pay long-term capital whatever profit it would have earned if they'd actually bought the stock. And if the stock declined, long-term would...
I've been told that there are people out there that aren't watch enthusiasts. Apparently, the vast majority of watch buyers just buy one watch. As a watch enthusiast, this is total news to me, and I'm shocked. If you had any self-respect, you should be spending all your available money on watches. You should be canceling vacations, maxing out credit cards, and your kids should be shoeless because that IWC Top Gun Seratanium chronograph is not going to buy itself. All kidding aside, maybe you think watch nerds like me are insane. You just don't want to spend all your disposable income on a product that your phone can do more accurately. Maybe your partner has threatened to leave you if you ever start droning on about lever and coaxial escapements. I get it. You just want one good watch. Well, this is the video. I've spent far too much time on watches, and I'm going to help out all you lucky souls that haven't been sucked completely into this hobby. This is the guide to getting a great one-and-done watch, but as usual, with a twist. Let's dive in. The Rolex. Over 1/3 of all Swiss watch revenue is Rolex. Odds are that a lot of people that want a one-and-done luxury watch are going to look to Rolex simply because it's the brand they know, and I'm not going to try and talk you out of it. I think Rolex has 5 potential one-and-done watches. It's the Explorer,